Good afternoon, members. I welcome you all for this today's meeting on quarterly returns and monthly payment scheme and issues under GST. As you all know, there are many changes which has happened in this quarter. Like for the next quarter, we are going to have the 3B. There is an option to file on a quarterly basis, but the payment has to be done on a monthly basis. How the amounts has to be paid, everything will be covered. And there are various issues as to input tax credit will be covered today. And we have our speaker, CA Arpit Haldia from Jodhpur. And on this brief note, I request our President, CA Ramdev for his welcome words. Over to CA Ramdev.
Thank you, Ritesh. Good afternoon, all the friends. Those who have joined and those who are joining, to all of them, I welcome you all to this meeting after a very long time. This meeting, actually, we wanted to have on ITC only, but our secretary Ritesh told, sir, this new scheme is going to be introduced from 1st January, quarterly return and monthly payment scheme. So I have requested Haldia sir to take this also. Otherwise, what I was thinking, there are issues only in ITC. When we go through GST, main issue which were existing in VAT regime and service tax regime still continue here also, particularly vis-a-vis classification. And due to these frequent changes, we are unable to cope with what is going on. It has created a lot of dilemma. This meeting is sought to address few issues relating to input tax credit and new scheme, quarterly return and monthly payment scheme. Otherwise, I think if we have on retainer basis one speaker to address our issues, even that would not have been sufficient. So much of vast frequent changes have been occurring and rapidly that we are unable to keep track of all these things, particularly during pandemic and afterward, this lockdown period, many changes are there. So I am really grateful to Arpit Haldia sir. When I requested him to address us, he told you decide date and topic. Any date, any topic, I am ready. So that was the great humbleness he is having. So I really appreciate your gesture, sir, and I welcome through virtual mode on this topic to our members. So I think after a long time since we are having a meeting, members are slowly joining. Since July 1st, we had nearly 30 meetings in a span of 3 months. So they were habituated to join regularly. Now that interruption has come. So again we have started. So this slowly people are joining. And actually we are having pan-India base now. Since we have created so many groups that from all over India people have joined in our groups and we are sending messages. However, this due date problem is also there. People are worried and it is the habit of the government also to keep guessing whether date will be extended or not. So what to do, what not to do, it is a big issue. Anyhow, whatever work is there, do it without taking any extra stress. Your client is not going to pay anything extra to you for the extra efforts you put in. Take it in due course. Particularly vis-a-vis tax audit, I will say this 271B penalty is not going to be levied. Why? If you agree that this delay has occurred because of auditor who is unable to complete, 271B is on the assessee. So don't take any stress. That is not going to solve your issues. Do it carefully. One more thing I would like to share, friends. This 23rd Wednesday from 4 p.m. we are organizing a meeting, interactive meeting with Principal Chief Commissioner of Income Tax Telangana and AP, JB Bandopadhyay, JB Mohapatra, IRS. And this meeting is being jointly organized with PATAPSI. He will be interacting with the members on Vivad Se Vishwas scheme. The due date for submitting Vivad Se Vishwas applications is 31st December. So I request all the members to make note of it, and already those who have filed their applications, they are facing few problems regarding demands in the form 3 which they are receiving. So all these issues we have discussed yesterday only with our principal chief commissioner. So he was agree to address and interact with us on these issues, and he was telling that some coordination committee at local level has been constituted, which is functioning to help and guide the applicants and tax consultants. We don't know, and he was asking me, I was surprised, you are not there in the committee. I don't know whether that a committee exists or not. How can I be part of that? So all these things are, as you know, there are restricted entries in the income tax department and other departments due to this COVID-19. So friends, we have taken it up to see that all these issues which we are facing are being taken up by the authorities, and they come to the guidance at very fast pace. Similarly, 2 days back, one session was conducted by CP Bangalore of Income Tax Department on ITR 7. So for that, yesterday we have contacted. So they were busy, it seems, and they told that they are coming out with some booklet and guidance note. They will circulate with us. As soon as we receive, we will share with you. So with this all, I welcome you all again and again, and with a request to make note of 23rd meeting and join this coming program also. One more program I have planned. So far, I have not yet contacted the speaker. I will not reveal the name. On charitable institutions, lot of changes are there. So as soon as it is finalized, I will share with you. So with these few words, I welcome you all, particularly Arpit Haldia ji. I would have loved to visit Jodhpur and meet Haldia ji because Jodhpur is famous for rabdi. Whenever I gone there, I have enjoyed it a lot. Very famous place. Our friends who are there, Ritesh Mittal, they know every year I go to Ramdevra. So I go via Jodhpur or Jaipur. So when I go via Jodhpur, after landing at Jodhpur, straight away we go to market, not anywhere else. And we have a snacks, rabdi, etc. and kachori.
Sir, my pleasure. Now you will not be required to go to market. You can come direct to my office. I will arrange it.
Very kind of you, very kind of you. Yeah, ji, very kind of you. So friends, with these few things, now I hand over to our secretary Ritesh Mittal for further proceedings. Thank you, Ritesh. Over to Ritesh.
Thank you to our President, C.A. Ramdev Gupta, for his welcome address. Before I request the speaker, C.A. Arpit Haldia to address the members, I request RTC invitee C.A. Hitesh Jain for introducing the speaker, C.A. Arpit Haldia. Over to Hitesh Jain. Hitesh Jain, you have to unmute yourself. Yes. Hitesh, unmute yourself, sorry.
Unmute. Hitesh bhai, unmute yourself.
No, sir, still not unmute. Yes.
Yeah. So good afternoon, everybody. Thank you, Ritesh, for giving me the privilege of introducing the learned speaker for today's program. It is CA Dr. Arpit Haldia ji. He is born on 5th June 1980 and he is from Jodhpur. He is currently working as a partner of Paritosh Gupta and Company Chartered Accountants since 2002. That is the year of his qualification as well. He is also an All India ranker in his CA inter exams. I think this 36th rank he has attained. Apart from CA, he has completed his company CS course, LLB course, as well as ICWA at various events, various point of time. He is primarily into direct tax, GST, and audit assignments. He is a regular speaker since 2007 onwards at various forums of the institute and also trade and professional bodies. He is a visiting faculty of NACIN, that is National Academy for Customs, Indirect Taxes and Narcotics for CGST officials, and on behalf of Deloitte, he is also training the SGST officials of Rajasthan. He has authored various books as well. Some of his primary workings are GST Made Easy, GST Mini Reader Reckoner, GST Search and Seizure, GST Samasya Evam Samadhan. That is in Hindi. So apart from English, he has also authored books in Hindi as well. And GST E-Way Bill, which are published by Taxman Publications. I told Dr. C.A. Haldia ji, the reason behind is that he is a PhD holder from Jai Narayan Vyas University on the topic of comparative study of existing system of sales tax and proposed system of VAT. So that is why I have added CA Dr. Haldia ji actually, because he has not written in his profile, but I think I have that opportunity to add this time. Apart from that, he has held various positions also in professional bodies. He is a member of the district level GST committee Jodhpur under the state government of Rajasthan. Then secretary, he's a past secretary of Tax Bar Association Jodhpur, past secretary Jodhpur branch of CIRC of ICI, and he before that he was treasurer and SICASA chairman as well. Apart from all these achievements of his, he is a regular blogger on GST. He has written more than 700 blogs. Even I have personally visited his website also. You will also find more than 230 case lost write-ups also you will find on the particular website. So with this, though he has given me only one page, but the depth of this one page is it's too large actually. So it is his humility with which he has given only one page profile, but I think I should add more to that. Thank you, everybody. Thank you for again for giving me the opportunity. Over to Ritesh ji.
Thank you, Tejan, for introducing the speaker. Now I request our speaker, Dr. Arpit Haldia, to address the Go to the speaker.
Sir, should I start now?
Yes, sir. Yes, sir.
Thank you, Riteshji, and thank you, Budratha, for giving me this opportunity to share my views on input tax credit and QRMPS. And thank you to Hiteshji for giving such a lovely introduction and adding something more to my introduction. Thank you very much. It was really a pleasure to hear it and privileged to be a part of this session on input tax credit and quarterly return monthly payment scheme. And I said that as Budratha has said that today we will be discussing and myself will be sharing my views on input tax credit and issues associated with it. There are a lot many issues which we are facing. That is 16(2)(c) payment of tax by the supplier. That is 16(4) applicability of time limit for claiming of credit. Rule 36(4) GSTR 2B has been recently introduced. What is its legal validity? Section 50 interest on delayed payment of taxes and the applicability of proviso which would be inserted in section 50. And then there is quarterly return monthly payment scheme. So we have our hands full for today, today's discussion, and I hope that I would be able to do justice with the topic. So sharing my presentation.
Yes, sir.
Is it visible?
Yes, sir. Yes.
So first, I would like to take up the topic input tax credit in GST, and before starting and deliberating on this subject, I would like to share one small thought over it, that there are three main issues associated with input tax credit. One is payment of tax by the supplier. Second is time limit for claiming of credit, and third is GSTR 2B and Rule 36(4). Keeping aside payment of tax by the supplier, this was the issue which has haunted us from the pre-GST regime only, pre-GST regime also. But regarding the 16.4 and Rule 36.4, which have been inserted in the GST regime only, what my view is that there are two options available with the assessee. Either he should follow the law, or in case he feels that the provision is unconstitutional and it is causing undue hardship, which is irreparable, then he should challenge the law. But the approach to remain in between, that we will see when the matter comes, that is the most hazardous approach which can be adopted in the matters of 16.4 or Rule 36.4. Because somewhere down the line, since the information system in GST is developing, the department is getting more and more information about the returns being filed and the comparative analysis, the analytical information. So to wait for something to come and then go along with the penalty proceedings and interest, and rather than, it would be better that if the stakes are high, then straight away challenge the law rather than opting as lying in between. But since we are at compliance stage, so our first responsibility is to get the clients educated about the law. That is section 16.4 and Rule 36.4. And if it is possible, ensure compliance. And if the matter goes beyond the compliance and it is not possible, then we should go and challenge the law. We have done in some of our cases wherein undue hardship was being caused to assessee regarding Rule 36.4 and application of GSTR 2B. But to adopt an approach which is in between, it can prove very hazardous going into the future. So with this brief background, we will be starting with today's discussion on input tax credit. And the first thing which I would like to discuss is a statement which we normally give or quote very loosely. Not almost all of us, not only some of the people, but almost all of us, we very loosely say that ITC is my vested right. That no, since I am registered in GST, nobody can take away the right to claim input tax credit from me. How much legal backing or constitutional backing this statement has? This is the first point of discussion, because once we are through with this discussion, then we would be going on to the rest of the topics which are there lined up for discussion today. So first issue which I would like to discuss is whether ITC is a vested right or a concession. By the term concession, what I mean to say is that it is a benefit, whether it is a benefit being granted by the government for availment of ITC, and for the purpose of benefit, if there are some conditions, how much legal backing those conditions have, that if I am able to fulfill those conditions, then only I would be able to claim credit, or without fulfilling those conditions, whether I am able to claim credit. So the first thing is whether input tax credit is a vested right or a benefit being granted by government subject to fulfillment of conditions. So the first discussion point on this issue is Article 300 capital A of the Constitution of India, which says that no person shall be deprived of his property save by the authority of the law. So there are two important things which I would like to discuss about Article 300 capital A. First thing it emphasizes, no person shall be deprived of his property. So the Article 300 capital A says is only applicable when I am the holder or I am the owner of that property. Anything should become a property to me, then only Article 300 capital A is applicable. And when something becomes my property, when I own it to the exclusion of others. But if I only have a chance to acquire that property, then it is not a property, it is only a chance subject to fulfillment of which I would be acquiring that property to the exclusion of others. So Article 300 capital A, right to property, which was a fundamental right previously prior to 1977, Article 19, that was removed and Article 300 capital A was introduced, not as a fundamental right but as a constitutional right, and it provided that no person should be deprived of his property. The word property is something which is owned by me, acquired by me to the exclusion of others. Second point, a person can be deprived of his property only by the authority of the law. So once something has become my property, I can be deprived of that property only by the authority of the law. But when the law provides that a particular person would be deprived of his property, that law should withstand the challenges of Article 14, Article 16 and Article 19 of Constitution of India. That law which is prescribing that a particular person would be deprived of his property should not be arbitrary, should not be unreasonable, should be equal, should have the right of equality as provided under Article 14 of Constitution of India. So this Article 300 capital A, if I see vis-a-vis input tax credit, it is applicable when ITC becomes my property. And the law, if once it becomes my property, then if the law deprives me of that right, that law has to withstand the test of Article 14, 16 and 19 of the Constitution of India. So Article 300 capital A, property, it should be my property, I should have acquired it to the exclusion of others, and I can still be denied of that my property by the authority of the law, but that law should be passing the test of Article 14, 16 and 19 of it, the Constitution of India. So with this background, let's first try to ascertain what is meant by the term vested right. What is the actual meaning which the courts have given to this term? Because we say that input tax credit is my vested right. So what is meant by the term vested, and when something becomes my property? Because once I have the vested right, then it becomes my property. But unless until it is my vested right, it is not my property. So the term vest was discussed by Honorable Apex Court in case of Howrah Municipal Corporation versus others, and Honorable Apex Court said the word vest is normally used where an immediate fixed right in present or future enjoyment in respect of property is created. So there should be an immediate fixed right, whether in present or future, for enjoyment of a property. Second, in case of Musamad Bibi, Sayyida and others, Honorable Apex Court again deliberated on the term vested, and it said rights are vested when right to enjoyment present or prospective has become property of some particular person or person as present interest. Mere expectancy of future benefits or contingent interest in property founded or anticipated continuing of existing law does not constitute a vested right. So mere expectancy of future benefits is not a vested right. I only expect that I would be having future benefits. It is not a vested right. Again, in the case of Hungerford Investment Trust, the mere right to take advantage of provisions of an act is not an accrued right. When we see these two decisions, in case of Musamad Bibi Siyadi and Hungerford Investment Trust vis-a-vis Section 16 of CGST Act, what Section 16 says, that if a person is able to fulfill the conditions as laid down in Section 16(2) A, B, C and D, then he would be entitled to the credit. So this presence of 4 conditions is critical for the purpose of entitlement to the credit. And unless until I would be satisfying those 4 conditions, Availability of ITC or claim of ITC is only an expectancy of future benefits or a mere right to take advantage of provisions of section 16. But once I fulfill all those four conditions, then I am entitled to the credit, and then nobody can deprive me of that right unless by the authority of the law. But supposedly, if the law provides that even after fulfilling the four conditions, a person would be deprived of the claim of ITC, then how does the Constitution comes to our rescue? That has been discussed by Honorable Apex Court in case of JS Yadav versus State of UP, wherein Honorable Supreme Court observed that in Union of India versus Tushar Ranjan Mohanty, this court declared the amendment with retrospective operation as ultra vires, as it takes away the vested right of the petitioner therein and thus was unreasonable, arbitrary, and violative of Article 14 and 16 of the Constitution. So any law which is providing that a person would be deprived of his property, whether by retrospective operation of a law or whether otherwise, that law would be held to be unreasonable, arbitrary, violative of Article 14 or 16 unless it fulfills the conditions laid down in those articles. So if I summarize the entire thing about vested right, presence of section 16 in CGST Act is a mere right to take advantage of provisions of the Act. It is not an entitlement. It is only a mere expectancy of future benefits or mere right to take advantage of the provisions of the Act. Once I fulfill all those four conditions, then only I am entitled to the input tax credit. And once I am entitled to the input tax credit, any provision which provides to deprive me of that right should not be unreasonable, arbitrary, or violative of Article 14 and 16 of Constitution of India. So this is how the entire chain will go. First, presence of section 16, it is a right to take advantage of provisions of the Act. On satisfaction of all those four conditions, it becomes my vested right. I become entitled to claim credit, and once I become entitled to claim credit, if anybody denies me of that right, that law has to be reasonable. That law should not be arbitrary. That law should not be violative of Article 14 and 16 of the Constitution of India. Now comes the second important question. We have discussed the term vested right. Now comes the second question, whether ITC is a vested right or a benefit or a concession. By the term benefit or a concession, what we mean is that the person who is granting the other person that benefit, it is purely up to his prerogative that how that benefit should be granted and what are the conditions which should be given or which should be associated for the benefit to be claimed by the recipient. So if I am the government, I am giving the right to claim credit. If it is a benefit, then as a government, I am entitled to put certain conditions for the claim of ITC. And if the recipient is able to fulfill those conditions, then only it becomes a vested right. But up till those conditions are fulfilled, it is only a benefit or a concession by the government. Now this hypothesis we have to see in light of the judgment which have been given by Honorable Apex Court in pre-GST regime. There have been no judgments post-GST regime, but in pre-GST regime, in my opinion, there are 6 landmark judgments on this issue, that whether ITC is a benefit or a concession and a person has to fulfill the conditions for the purpose of claiming of that benefit or a concession. The first is in the case of Godrej and Boyce Manufacturing Company Private Limited versus Commissioner of Sales Tax and others. Now this decision, these are the 6 decisions. I would be reading verbatim because these 6 decisions lay down a very important concept. And in the first case, Honorable Apex Court said that we fail to understand how a valid grievance can be made in respect of such deduction when the very extension of the benefit of set off itself is a boon or a concession. What happened in this case was that government of Maharashtra allowed credit of the tax paid on purchase, but they provided a deduction of something of 1% from the taxes paid to the seller, and this provided that a deduction would be made, and after that deduction whatever amount is there, the recipient is entitled to claim the credit. The petitioner reached before the Honorable Apex Court and challenged the deduction of that 1%. That why this deduction of 1% is being made, I am entitled to the entire amount which has been paid to the seller. And Honorable Apex Court said that the very extension of benefit of set off is itself a boon or a concession. In the second case, now there are three landmark judgments which have been given in 2016, 17 and 18. The first is Jayam and Company versus Assistant Commissioner Another. This is TN VAT Act, wherein they said that it is a trite law that whenever concession is given by the statute or notification, the conditions thereof are to be strictly complied with in order to avail such concession. Thus, it is not the right of the dealers to get the benefit of ITC, but it is a concession granted by virtue of Section 619 of TN VAT Act. So, Honorable Apex Court clearly laid down this principle that the very right to claim ITC is not a vested right, it is a benefit which has been granted by the Act, and it is subject to fulfillment of conditions provided in the statute. Now, the third decision, Karnataka VAT Act, the state of Karnataka versus MK Agrotech Private Limited. Again, Honorable Apex Court followed the same rationale. However, how much credit is to be given and under what circumstances is the domain of the legislature, and the courts are not to tinker with the same. How much credit is to be given and under what circumstances? If we see it vis-a-vis Section 16 or Section 17, Section 17 provides how the proportionate credit would be disallowed in case of ineligible supplies. If we go through Section 16, the conditions which have been provided under Section 16.2 or Section 16.4 are the circumstances under which the credit would be given. Now, it is purely the domain of the legislature that what are the circumstances and how much credit is to be given, and the court would not tinker. Because unless until I would be fulfilling those conditions, it only remains an expectancy of future benefits and a benefit being provided or a concession being provided by the government. Now, the fourth judgment, ALD Automotive Private Limited versus the Commercial Tax Officer. This was given in 2018. The concession can be received by the beneficiary only as per the scheme of the statute. So this was the last decision on input tax credit in the pre-GST regime, which clearly provided that the concession can be received by the beneficiary only as per the scheme of the statute. Now, if the scheme itself is having some fault, then that's the issues which are having the fault can be challenged, but the entire scheme cannot be challenged, that why they have put certain conditions. If those conditions are violative of Article 14, those conditions are not proper, then we can challenge those conditions. But we cannot challenge that why the restrictions or the conditions have been provided for the purpose of claim of ITC. Now, if we go through two landmark decisions which are regularly quoted while stating the claim that import tax credit is a vested right. The first is Eicher Motors Limited and another versus Union of India. This is a case of excise regime which was given by Honorable Apex Court in 1999. And what this judgment said, thus the assessee became entitled to take the credit of the input instantaneously once the input is received in the factory on the basis of the existing scheme. Again, the emphasis is that the assessee became entitled to the credit of input once the input is received. But why? Because the existing scheme provided that the assessee would be entitled on the receipt of inputs. It is not as if the rest of the other conditions were not fulfilled and only since the goods were received, the assessee was entitled. The existing scheme at that time provided that the assessee would be entitled to claim credit on the basis of receipt of the goods. Second judgment, Collector of Central Excise Pune versus Daiichi Karkaria. It is clear from these rules as we read them that a manufacturer obtains credit of the excise duty paid on raw material to be used by him in the production of an excisable product immediately it makes the requisite declaration and obtains an acknowledgement thereof. So again, when the assessee becomes entitled at that time, he became entitled immediately, it makes the requisite declaration and obtains an acknowledgement thereof. So for the purpose of eligibility of the credit, making of the requisite declaration and obtaining the acknowledgement were the prerequisites for the claim of credit. And unless until the declaration was made or the acknowledgement was not obtained, the assessee was not entitled to the credit. Now the entire concept of making the declaration and obtaining an acknowledgement thereof in present times is somewhere equivalent to filing of the return and claiming of ITC. So this is how, if we go through all these 6 decisions, one thing which very clearly comes out, that first of all, ITC is a benefit or a concession. And the conditions attached to that benefit or a concession have to be fulfilled. Once those conditions are fulfilled, then it becomes my vested right or my property. And once it becomes my vested right or a property, then no law can deprive me of that vested right or a property unless it satisfies the test of Article 14 and 16 of the Constitution of India. So therefore, the conditions which have been provided in the Section 16 of the GST Act have to be fulfilled before I can say that ITC is my vested right. Now, if I have some issues with the conditions which have been provided, then I should challenge those conditions which are not proper or which are not satisfying the test of Article 14 or 16 of Constitution of India. So this was the background of whether ITC is a vested right or a concession. Now coming to the first point for today's session, that is Section 16(2)(c). If I go through Section 16(2), there are 4 conditions. First, I should have the eligible document. Second, I should have received the goods or services. Third, the supplier should have paid the tax. And fourth, I should have filed my return. So now we would be discussing the third condition. And once the third condition is discussed, then we will be moving on to the entire Section 16(2). So when I go through the third condition, which says that the supplier should have paid the taxes out of his eligible credit or through cash, how does I find myself against that condition? Whether that condition satisfies Article 14 or 16 of Constitution of India, or whether that condition is violative and is a condition which I cannot perform. Because I agree that for claiming of ITC, I have to fulfill the conditions. Now I am not challenging that I would not be fulfilling those conditions. I am challenging or I am discussing only the part which I feel that requires consideration of the court or the government. So before discussing section 16(2)(c), again I would like to discuss a very important principle of law which says lex not cogit impossibilia, that is, law does not compel a man to do that which he cannot possibly perform. Law cannot ask me to do something which I cannot possibly perform, or something which law is not helping me to perform that responsibility. For that, I have referred to some landmark judgment, although there are many landmark judgments on this principle. But there, I have tried to refer some landmark judgment. First, I have referred judgment of Honorable Bombay High Court in case of Commission of Income Tax versus Messrs. Celloplast. What happened in this case was that the assessee sold the property. And since he sold the property, he had some capital gains. And for the purpose of saving on the capital gains, he intended to claim benefit under section 54 EC. Now, section 54 EC provides that the person should invest the capital gain part in eligible bonds. And at that time, there were two eligible bonds notified by the government. One is Rural Electrification Corporation Limited and second, National Highway Authority of India. But during those 6 months, none of the two companies issued the bonds. So the assessee approached the Honorable Bombay High Court and said that during these 6 months, none of the companies issued their bond. So how I can be expected to comply with the condition of section 54 EC? So what Bombay High Court said, however, as the bonds were not available, it was impossible for the respondent assessee to invest in them within 6 months of the sale of their factory building. So they referred to the principle lex not cogit impossibilia and then provided that it was impossible for the assessee to invest in them within a period of 6 months on the sale of factory building. Another judgment of Honorable Allahabad High Court, wherein it was observed by Honorable High Court that if the authorities for their own default sit tight and idle, did not bother for making the forms available to the institutions, is it permissible subsequently to the authorities to require the college and the student to adhere to the time schedule prescribed in the regulation and else face consequences? So if the authorities are not releasing the forms in time, whether the students can be asked to comply within the given time frame. First, it is the responsibility of the authorities to release the forms in time, and then they can enforce the time limit upon the student for submission of the examination forms. Here, Honorable Allahabad High Court said that the law does not compel a man to do that which he cannot possibly perform. Where the law creates a duty and the party is disabled to perform it without any default in him and has no remedy over there, the law will excuse him. So if the law has casted a duty upon me and I am disabled to perform it without any default of me, I cannot be held responsible for the non-performance of that responsibility. And when we go through this decision, somewhere we are able to associate it with the forms being released by the Income Tax Department. At first, it is the duty of the department to release the forms in time, and then they can only ask the assessee to fulfill his responsibility of filing the form in time. And same thing goes for GST as well. The third landmark judgment, that is State of Rajasthan versus and another versus Shamsher Singh. It has been indicated therein that however mandatory the provision may be, where it is impossible of compliance, that would be a sufficient excuse for non-compliance, particularly when it is a question of the time factor. So, however mandatory the provision may be, but if it is impossible to be performed, then I would be excused for that non-performance. Another landmark judgment. The law does not, in case of presidential poll versus annul, this is a Supreme Court judgment which said the law does not compel one to do which one cannot possibly perform. Where the law creates a duty or charge and the party is disabled to perform it without any default in him and has no remedy over it, there the law will in general excuse him. Therefore, when it appears that the performance of the formalities prescribed in the statute has been rendered impossible by the circumstances over which the person interested had no control, this is a valid excuse. So, if I go through all these decisions, one common thing flowing from all these decisions, I cannot be compelled to do a thing which is impossible for me to perform. And if the law is asking me to do the impossible, that non-performance would be excused by the law because I am being asked to do the impossible thing. So how does this principle help me out in section 16.2c? Now if I go through section 16.2c, it says that subject to provision of section 41 or section 43a, the tax charged in respect of such supply has been actually paid to the government. Now this condition up till this point is somewhere similar to the conditions which were there in VAT regime, which provided that the seller should have deposited the tax. And we were facing huge challenge to meet that condition, but GST goes one step ahead. And it not only says that the tax should have been paid to the government, it should have been paid either in cash or through utilization of input tax credit admissible in respect of the said supply. So as a recipient, I am not only to ensure that my supplier has deposited the tax, I also have to ensure that if the tax has been deposited through utilization of input tax credit, that credit should be admissible to him. So there are two conditions now in GST. First, the recipient should ensure that the tax has been deposited, and second, if the tax has been deposited through utilization of ITC, that ITC should be admissible to him. Now the question comes, if we see this condition in light of the principle which we have discussed, that law cannot ask me to do the impossible. Does the recipient in GST have the right to enforce this provision on the supplier? How does he ensure that the supplier complies with this condition? That he should deposit the tax, and he should deposit the tax by utilizing ITC admissible to him. Is this thing in his control to enforce this compliance? What are the rights available to him in the statute for enforcing this compliance? Can he attach his bank account for non-deposit of tax? Can he go to his business premises and ask him to produce his books of accounts and records to ensure that proper ITC has been availed by him? Does he have the right to ask to be present in front of him that why you have not deposited the tax? All these powers are not vested with the recipient, these are vested with the officer. And if the officer is not able to ensure the compliance of the is not able to enforce this provision on the supplier, how can a recipient be asked to perform this task? Recipient is basically a toothless person who has been burdened with the compliance of all the responsibilities in the Act, for which he is having no powers in the Act. And ensuring this condition is something equal to asking him to do the impossible. So what is possible for a recipient? Let's first discuss this, and then we will be going on to the impossible part. Having a valid document in possession is a possible condition to be fulfilled. That is 16.2a. I cannot say that condition in 16.2a is an impossible condition. if I am not having a valid document, the officer or the revenue is well within their rights to deny me the ITC, because this is a benefit which has to be availed by me subject to fulfillment of conditions. What is a valid document? Rule 36(1) provides a detail. In case, supposedly, if it is an import, then it is a bill of entry. If it is a forward charge, if it is an input tax credit claimed on the basis of supplier charging me the tax, it is the invoice. If it is a reverse charge, then it is a self-generated invoice subject to payment of tax. Rule 36(2), which says that the invoice which the recipient is having should mandatorily have 5 particulars on the invoice, out of which one is the recipient GST. So for being a valid document, if I go through section 16(2)(a), read with rule 36(1), 36(2), the first condition which I should fulfill is that I should have the invoice along with my GST mentioned on this as the recipient of that invoice. Second, I should have received the goods or services. Without receiving the goods or services, I am not entitled to take the credit. So this is my second condition. And both these conditions are well within my reach to be fulfilled. This condition, second condition, is section 16(2)(b). In addition to these two conditions, I can have a valid e-way bill. I should have a valid e-way bill. Third, I should have the proof of goods being transported from the supplier to the recipient, that the goods actually moved from the supplier to me. And if possible, if there are toll receipts attached available, the toll receipt should also be made part of documentation. Next condition, I should have the proof that I have paid the amount to the seller. It can be a payment through check, it can be a payment through cash subject to acknowledgement by the supplier. So in my opinion, I should have a valid document for the purpose of claim of credit. I should have received the goods. I should have a valid e-way bill if applicable. I should have the proof of transport of goods. I should have the proof of payment that I have paid the consideration to the supplier. Now these are the conditions which are all within my domain to be completed. But asking me that in addition to these conditions, you should also ensure that the supplier has deposited the tax. This is asking me to do the impossible. And there are two judgments. One of the Honorable Delhi High Court and second of Honorable Rajasthan High Court. One is in case of Arise India Limited, as we all have read till date and mentioned it many times. But I have referred these two decisions for the specific aspect that these two decisions also provide that a person cannot be asked to do the impossible. If I go through the decision, it says, therefore, there was a need to restrict the denial of ITC only to the selling dealer who had failed to deposit the tax collected by them and not punish bona fide purchasing dealers. The latter cannot be expected to do the impossible. So Honorable Delhi High Court specifically observed that you cannot punish bona fide purchasing dealer, you have to punish the erring selling dealer. You cannot expect the buyer to do the impossible. That is the genuine buyer. Second, in case of RS Infra Transmission versus State of Rajasthan, Honorable Rajasthan High Court, wherein they observe we are in complete agreement that it will be impossible for the petitioner to prove that the selling dealer has paid tax or not. As while making the payment, the invoice including tax paid or not, he has to prove the same, and the petitioner has already put summary on record which clearly established that the amount which has been paid to the selling dealer, including the purchase amount as well as the tax amount. So first, Honorable Rajasthan High Court observed that it will be impossible for the petitioner to prove that the selling dealer deposited the tax. What he can prove and what he has proved through the summary which is available on record, that these are the invoices which are available to him, and he has made all the payment relating to the invoices to the seller. So if I go through these two decisions, these two decisions also clearly emphasize that a genuine purchaser cannot be asked to do the impossible. Although these two judgments do not refer to the principle, let's not forget impossibility, but the principle underlying these two judgments is the same. So whenever we come across situations which wherein section 16(2)(c) has been invoked by the revenue, what we should do is provide the invoices, provide the proof of receipt of goods, provide the proof of transportation of goods, provide the e-way bill, provide that the taxes have been paid. And in addition to that, there is one new facility which has been started by GSTIN of communication to the buyer, to the seller. We can make a communication to the seller that you have not deposited the tax in respect of these invoices. But even after making the communication, if the seller does not make the payment of tax, I cannot be held responsible under section 16(2)(c) to reverse the credit. Again, I am fulfilling whatever responsibility is there in my hand. But mere making communication does not enforce the seller to deposit tax. It is the work of the Department of the Revenue to enforce the seller to deposit the tax. What we have done in some cases, because this facility has been started just now, we have registered in big cases this problem that the seller has not deposited tax on Prime Minister Grievance Portal under financial fraud. And that issue which we have raised on the CP-Gram portal under financial fraud has traveled, because the CP-Gram portal shows that where your matter is pending. That matter, as to the present status, is pending with the jurisdictional commissioner of the selling dealer. Now, even though we have complained and the matter is pending with the jurisdictional commissioner of the selling dealer, and if they are not able to enforce or collect the tax from the erring selling dealer, how can a buyer be asked to prove that the supplier has deposited the tax? So this is how we should see the entire matter, and whatever which is in our control, we should fulfill only that responsibility, and then we can always raise the contention that whatever was in my hand, I have done it, but I cannot be asked to do the impossible. If the seller has not deposited the tax, if I am a genuine purchaser, the officer has to take the action. I cannot take the action, and I cannot be deprived of my right. Because again, this condition of seller depositing the tax being enforced on the buyer is violative of Article 14 of Constitution of India. It is unreasonable, it is arbitrary, and cannot be enforced on a genuine purchaser. Now, keeping in this respect the discussion we had on section 16(2)(c), let's try to discuss the issue of credit being reflected in GSTR 2A. I would divide the situation in two parts. One is prior to 9th October 2019, the credit which has been availed prior to 9th October 2019. And second, the credit which has been availed after 9th October 2019. Because on or after 9th October 2019, Rule 36(4) was in place in CGST rules. And we would be having a separate discussion on Rule 36(4). So for the situation prior to 9th, credit availed prior to 9th October 2019, we would be having a small discussion. Now, there was a press release on 18th October 2018, which provided that GSTR 2A is only a facilitation measure provided by the government. However, the ITC would be claimed by the assessee on the basis of his own self-assessment, in consonance with the provisions of Section 16 of the Act. So, this was made very clear that GSTR 2A is only a facilitation measure, and it does not affect the right of the assessee to claim credit as per Section 16 of the CGST Act. So now we have three conditions which we very commonly come across. First is, what if my supplier has filed GSTR 1, that is, it is reflecting in my GSTR 2A, but he has not filed his GSTR 3B and I have my tax invoice. So the credit is being reflected in GSTR 2A. This is prior to 9th October 2019. Credit is being reflected in GSTR 2A. I have a valid tax invoice, but he has not filed GSTR 3B. Whether I can be denied the ITC. See, again, merely reflecting in GSTR 2A is not the proof that the tax has been deposited. Ultimately, the conditions as provided in the statute will prevail. So, if the entry is being reflected in 2A, but the supplier has not deposited the tax or has not deposited 3B, then the department is well within their right to invoke Section 16(2)(c) and deny the credit. And in such cases, what I should do is whatever is in my control. And what is in my control? Having the tax invoice, proving that the goods or services were received, proving that the goods were transported, proving that I have valid e-way bill, proving that I have made the payment of entire consideration to the seller. And if and where applicable, I have lodged the complaint against the seller, or I have made the communication to the seller. This is all I need to perform and satisfy, and even after this, the department is invoking Section 16(2)(c) that the supplier has not filed GSTR 3B. Then in such case, I should litigate the matter, and I am very hopeful that come soon in the future, Section 16(2)(c) would be read down for the genuine purchasers, and if the genuine purchasers are having sufficient documents, they would be entitled to the credit. Second, what if I have tax invoice and my supplier has filed 3B but has not reflected my GST and GSTR 1? Now again, I have the tax invoice. My supplier says that he has deposited 3B, and in that 3B, the sale invoices has been added and the tax on those sale invoices has been discharged to 3B, but due to my failure of my accountant, I uploaded your sale in B2C rather than B2B. Now in such case, as we discussed earlier, reflection or entry in GSTR 2A is not a proof that the supplier has not deposited the tax. If I am able to get an evidence from the supplier that this is your ledger account, I certify that tax on these invoices has been paid by me in the relevant GSTR 3B file for the respective months. And it was my fault that I was not able to upload those invoices in B2B rather than B2C. Then department cannot deny me the credit, because reflecting in 2A is not a mandatory legal condition. Mandatory legal condition is Section 16(2)(c). And for this, one thing which we should ensure that the purchase invoice should have the GSTIN of the recipient. Because if the GSTIN of the recipient would be missing, then how the supplier would be uploading the details correctly in his GSTR 1? But in cases wherein the entry is not reflecting in 2A, but the seller has deposited the tax, I can always provide my officer with additional evidences. And mere non-reflection in 2A would not be hindering my right to claim the credit. Now, third condition. What if I have tax invoice and my supplier has neither filed 3B nor filed GST-R1? Now, this is the extreme case wherein I have the tax invoice, the goods have been received by me, goods were transferred to me, I paid the entire consideration to my seller, but my seller has neither filed 3B nor filed GST-R1. Again, the discussion in section 16.2c that I have fulfilled whatever is within my purview, but I cannot be asked to do the impossible of ensuring that the seller has deposited the tax. It is for the government to do the thing. It is not for me to ensure the compliance. Or give me the powers in the statute to enforce the compliance, to attach his bank account, to serve a notice from him, to access his premises and verify his records. But unless until these powers are given to me, I cannot be asked as a toothless assessee to enforce the compliance of the law. So this is all about section 16.2c and the mismatch in credit or treatment of seller not depositing the tax up to 9th October 2019. That is credit availed up to 9th October 2019. Now after 9th October 2019, we would be discussing Rule 36.4 subsequent to this discussion. Now we come on to the second topic of our day, section 16 subsection 4. That is the time limit provided in the statute for the purpose of claim of credit in respect of an invoice or a debit note. Now the first thing which we will discuss is how far the legislature is entitled to provide a time limit in the law for the purpose of claiming of credit. Somewhere down the line, we very commonly say that how can a time limit be prescribed for the purpose of availment of credit? It is my vested right. They cannot provide a time limit in the law for the purpose of claim of credit. Now, if we go through the decisions of Honorable Apex Court, then that is in case of ALD Automotive Private Limited versus the Commercial Tax Officer given in 2018. Honorable Court clearly provided the condition under which the concession and benefit is given is always to be strictly construed. In event it is accepted that there is no time period for the purpose of claiming of ITC, the provision becomes too flexible and gives rise to large number of difficulties, including difficulty in verification of claim of ITC. So, Honorable Apex Court upheld the constitutional validity of the provision which provided the time limit within which the ITC was to be claimed, and said that if the statute would not be containing a provision for providing a time limit within which ITC has to be claimed, it would become a flexible right which will be giving rise to innumerous difficulties in matching the credit. Therefore, we thus are of the view that the time period as provided in section 1911 is mandatory. So whatever time limit which the statute provides for the purpose of claim of credit has been held to be constitutionally valid by the Honorable Apex Court in case of ALD Automotive Private Limited. So first thing goes out of our discussion that law cannot provide the time limit. Law can provide the time limit, and assessee is expected to fulfill their responsibilities within the given time limit. So this section 16.4 provides a time limit of 6 months from the end of the financial year. Due date for filing of return for the month of September from the end of the financial year. So for supposedly for 1920, it is 20th October or 24th October 2020. If I give it a impartial view and leaving aside initial years of 17, 18 and 18, 19, because everybody faced a problem at that time. Since the law was new, the systems were developing, so therefore they were not able to claim the credit within the given time limit, or they needed some relaxation. But if I discuss about 1920, in my opinion, 6 months from the end of the financial year is sufficient enough time limit for the purpose of ensuring that ITC has been claimed. Leaving aside there was a pandemic in 1920, but in normal scenarios, in normal years, 6 months from the end of the financial year is sufficient enough for the purpose of claim of credit, because had normal circumstances would prevail, income tax returns for 1920 would have been filed by the due date of July or by September. That means my books of accounts for 1920 would have been completed by that time, and law gives me additional 20 days from the end of the 6 month period to claim the rest of the credit. So giving it an impartial view, this time limit is sufficient. And if we are at the compliance stage, see, there are two stages in my opinion. One is the compliance stage and second is the litigation stage. Being an SSC, everybody can afford compliances. But being an SSC, not everybody can afford litigation. So if the compliance is in my hands and if the SSC is able to comply with, the first effort should be to comply, because litigation of section 16(4) would be traveling up to the Honorable Apex Court. It is not something which would be settled at the Commissioner Appeals level. So an SSC, if he is able to comply with section 16(4), I am not saying about 17, 18 and 18, 19, because those were exceptional years, those were new years and people were still getting acquainted with GST. So there might be a scenario wherein the government should have a beneficial view. But going further into the future, section 16(4) time limit is something which can be ensured at the compliance stage, and if there's some issues due to which compliance cannot be made or undue hardship is there for the assessing, then in my opinion the litigation starts for section 16(4). Now this was the initial discussion of 16(4), but now we would be discussing how section 16(4) lines up in the statute with section 16(1) and 16(2). Yes, the legislature is entitled to provide a time limit for the purpose of claim of ITC. There is no doubt about it. In my opinion, there is a very clear-cut decision of Honorable Apex Court. But then the framing of the statute should be so that the intention comes out very clearly. How does the framing of the statute is there in GST? Whether it is clearly coming out that section 16(4) time limit is overriding all the other provisions in the Act. And this time limit, if not complied with, will be affecting the right of the assessee to claim the credit. Now, if I go through section 16(1), which contains provision for entitlement of ITC, it says that every registered person shall, subject to such conditions and restrictions as may be prescribed, be entitled to take credit of input tax charged on any supply of goods or services. What section 16(1) is saying, that a person would be entitled to take the credit. For me, entitlement and taking are two separate things. First, I would be entitled and then I would be taking. And when I am entitled to something, it becomes my right, and taking is a subsequent action. If I go through section 16(4), it again says that a registered person shall not be entitled to take. Again, it is speaking about entitlement to take. First, I would be entitled and then I would be taking. So, which provisions? Provision says about entitlement. These two provisions are saying about entitled to take. Which provision says about entitlement? Section 16(2) says about entitlement. And it starts with a non-obstinate clause, notwithstanding anything contained in this section. That is, it is overriding section 16(1), it is overriding section 16(4). And if I am able to comply with provisions of section 16(2), that entitlement would be overriding 16(1) and 16(4). And what it says, that notwithstanding anything contained in this section, no registered person shall be entitled to the credit. Now, it is not speaking about entitled to take the credit, it is speaking about entitled to the credit. And it is this entitlement upon satisfaction of which ITC becomes my vested right. First I am entitled and then I am taking. So if the provision of entitlement is overriding section 16(1) and 16(4), how can the taking part override entitlement? Had the language of the section would have been such, notwithstanding anything contained in this section subject to provisions of section 16 subsection 4. Then in such case, provisions of section 16(4) and its time limit would have been binding on section 16(2). But there is no such term of subject to section 16(4) and 16(2). It clearly says, notwithstanding anything contained in this section, that is 16(2) is overriding 16(4). And once I fulfill the conditions as provided under 16(2), that is A, B, C and D, I become entitled to the credit, and whatever time limit I take for satisfying those conditions, even if it goes beyond 16(4), it would not hamper my right, because 16(2) is overriding 16(4). It is not subject to 16(4). So in my opinion, if we go, I agree that the statute or the legislature is entitled to provide a time limit for the purpose of claiming of credit, but the manner in which CGST Act has been drafted, it says that 16(2) is overriding 16(1) and 16(4), and if upon fulfillment of conditions as provided in 16(2), I become entitled to the credit. A time limit which is provided in 16(4) cannot override substantive part of 16(2). It should have been drafted as notwithstanding anything contained in this section subject to the provisions of section 16(4). Likewise, we have seen in 16(2)(c) when it says that subject to sections of section 41 and section 43A, the supplier should have deposited the tax. The same manner of subjecting the provision of 16(2) to 16(4) should have been there, and in the absence of such provision, in my opinion, 16(2) overrides 16(4), and even if I fulfill those conditions beyond the time limit in 16(4), my entitlement is not affected, and once I become entitled, and 16(4) is not overriding 16(2), there is no time limit there at present for the purpose of claim of ITC. Again, this is a matter of litigation. This is how we can argue. But the first thing which, if possible, that we should ensure the compliance. The second argument, that is the retrospective amendment of Rule 61(5). On one fine day on 9th October 2019, after the judgment of Honorable Gujarat High Court in case of Arp and Company, government realized that there is a lacuna in the statute. And what they did, they retrospectively amended Rule 61(5) and provided that provided that where a return in form GSTR 3B is required to be furnished by a person referred to in sub-rule 1, then such person shall not be required to furnish the return in form GSTR 3. So by providing the proviso, they said that if 3B has been filed, there is no requirement to file GSTR 3. And this was a retrospective amendment in Rule 61.5. Now, if I see two notifications, one was on 28th June 2019 and second was on 9th October 2019. These two notifications are notification which provide due date of filing of GSTR 1. So the notification of 28th June 2019 provides due date of filing of GSTR 1 for the month of July 19 to September 19. And this notification of 9th October 2019 provide due date of filing of GSTR 1 for October 19 to March 20. This is not the relevant part at how GSTR 1 due dates have been provided. The relevant part is in condition number 2. Condition number 2 in 28th June 2019 notification number 28/2019 says the time limit for furnishing the details or return as the case may be under subsection 38(2) and subsection 1 of section 39, that is GSTR 3 of the said act for the month of July 19 to September 19 shall be subsequently notified in official gazette. That they were saying to me on 28 June 2019, and up till all those notifications which have been released up till 28 June 2019 for filing of GSTR 1, that we would be notifying a date for filing of GSTR 3 under section 39(1) later on in the official gazette. So I was made to believe that this notification would be coming for furnishing of GSTR 3. So there is a principle called theory of legitimate expectation, wherein someone is making me to believe that yes, I would be doing that thing, and I am believing that this thing would be done. Then I cannot be deprived of my right which I would have acquired if that thing would have been done in the manner it has been assured to me. The government was making me to believe that we would be bringing GSTR 3, and there was a circular of 2nd September 2017 which provided that if any ITC has been left to be claimed in 3B, you can claim it in GSTR 3. So if I read that circular along with this notification, I was made to believe that 3 would be coming and you can file that 3 under section 39(1). But what happened on that fine day on 9th October 2019 when they made the retrospective amendment? Now this notification 46/2019 which provides filing date for October 19 to March 20. Now it says that the time limit for furnishing the details or return as the case may be under subsection 38(2), that is GSTR 2 of the said act for the month of October 19 to March 20 shall be subsequently notified in the official gazette. Now the reference to 39(1) is not there in the notification of 9th October 2019. So they are very smartly amended retrospectively Rule 61.5 and also removed the reference of section 39(1) from the notifications issued thereafter for filing of GSTR 1. But all those notifications for filing of GSTR 1 which were issued up till 30th September 2019 are containing still reference of section 39(1) return, and they have not been amended till date. So if those notifications are there still in the statute, we are saying that GSTR 3 for September 19 will be notified. Those notifications up till 30th September 2019 were making me to believe that 3 would be coming. And since 3 would be coming and the circular was saying that you would be able to rectify your mistakes in 3, which you have committed in 3B. I was being made to believe that this 3 would be coming. And any reference to 39.1 till 30th September 2019 cannot be for 3B. It can only be for 3. And this is how the theory of legitimate expectation comes in force, that I was made to believe something by the legislature. I was relying upon them. And since they have not brought those forms and made a retrospective amendment, it is purely arbitrary. It is irrational. And it is taking away a right to me which was continuously being assured by them. So this would be the second, this can be the second contention in case a matter comes for section 16 subsection 4. Now the third part, that is, this is the agenda for 31st GST Council meeting held on 22nd December 2018, which said, a perusal of above provisions indicate that the law permits furnishing of a return without payment of full tax as self-assessed as per the said return, but the said return would be regarded as invalid return. The said return, however, would not be used for the purpose of matching of ITC and settlement of funds. So what this agenda initially said, that law permits filing of return without payment of full tax as self-assessed. That filing of return would not be a valid return for the purpose of matching of ITC. But other than that, it would be a valid return. Thus, although the law permits part payment of tax, but no such facility has been yet made available on the common portal. Therefore, law permits part payment of tax, but no such facility has been yet made available on the common portal. This was an admission in 31st GST Council meeting held on 22nd December 2018. Now, how this admission of the board while framing the agenda helps a taxpayer? See, what was the initial plan in GST? If I go through section 16.2 A, B, C and D, there is a certain methodology associated with each of the 4 clauses. What it says is, 16.2A says that I should have a valid invoice. When I have a valid invoice, that means my supplier has issued the invoice, and on the basis of that invoice, he would be filing GSTR 1. So 16.2A, having a valid invoice, is linked with GSTR 1. When 16.2B says that I should have received the goods or services, it is somewhere linked to GSTR 2, that whenever I would have received the goods or services, I would have accepted the entry which has been filed by my supplier in GSTR 1. So 16.2B, the condition of goods being received is associated somewhere with GSTR 2. Once I have accepted the entry, that entry would have been freezed in the records of my supplier, and on that basis his GSTR 3 would have been auto-populated. So 16.2C is somewhere associated with the return being filed by the supplier in GSTR 3. And once he has filed the return and deposited the tax, 16.2D says that the recipient should also have deposited his return. So 16.2D is associated with GSTR 3 being filed by the recipient. So if I see 16.2A, filing of GSTR 1 by the supplier, 16.2B, filing of GSTR 2 by the recipient, 16.2C, filing of GSTR 3 by the supplier, and 16.2D, filing of the GSTR 3 by the recipient. And in this entire scenario, once the credit has been reflected in GSTR 2 and I would have accepted the credit, that credit would have been flown to my of that credit would have gone to my credit ledger. And this is what this agenda also says, that in addition to that, the law in section 39 says that a valid return would be when the tax has been deposited. That valid return is for the purpose of matching of ITC and settlement of funds. But law does not anywhere say that you cannot file a return without payment of tax or with part payment of tax. It is this 3B which has made a condition that unless until entire tax has been deposited, a person cannot file his 3B, and since he cannot file his 3B, he cannot claim the credit as well. Supposedly, for the month of March, I have an output liability of say 1 crore rupees. My ITC is of 60 lakh rupees. And I have to make a payment of 40 lakh rupees. So I would be required to make a payment of 40 lakh rupees for the purpose of claiming of credit of 60 lakh rupees. And unless until I would be making the entire payment of 40 lakh rupees, I would not be able to claim credit of 60 lakh rupees. This is the restriction being put by the portal. This is nowhere in the law that a assessee cannot file his return with part payment of tax. And that is why it has been admitted by the board that thus, although the law permits part payment of tax, but no such facility has been yet made available on common portal, because 3B can be filed only when the entire liability has been discharged. So how does this help me in 16.4? Now I take two different scenarios. First is, I have an output liability of 1 crore rupees and I have an ITC of 60 lakh rupees and I have to pay 40 lakh rupees. Now I don't have those 40 lakh rupees and I have to file the return for the month of March, say 20. And since I don't have those 40 lakh rupees, I am not able to file my return up to 24th October 2020 or say 20th October 2020 as the case may be. Now this admission says that since I cannot file my 3B because I don't have 40 lakh rupees, I am not able to claim that 60 lakh rupees as well. And this is a restriction by the portal. And this restriction of portal is going beyond the law, because they said that although the law permits part payment of tax, but no such facility has been made available on the portal. So I can say that since I was facing a financial crunch and I was not able to deposit those 40 lakh rupees, so I was not able to claim the 60 lakh rupees credit within the prescribed time limit. And this mandatory condition of paying the tax for filing of return and for the purpose of claiming of credit is only due to the portal. It is not coming out of the law, because law permits furnishing of return without payment of full tax as self-assessed as per the said return. And secondly, if this is a restriction made by the portal and not by the law, then I am only challenging the portal. I am not challenging 16.4. Second scenario, supposedly I have an output liability of 1 crore rupees and I have an input of 1 crore 20 lakh rupees. Now in this case, I am not required to pay any tax. I only have to file the return. And if I am not able to file the return, even though I was having sufficient credit, then I cannot take help of this contention. So in those cases where there is a huge amount of tax to be paid, and since the assessee was facing financial crunch and he was not able to claim the credit because 3B is not allowed to be filed without payment of taxes, and which is not as per the original how the law has been drafted or as per the provisions of the law, I can always challenge in the court, taking help of this argument that I am challenging the restriction of the portal. I am not challenging 16.4. or I am not challenging the provisions of the law. So these are some of the contentions, in my opinion, which can be validly taken. There are certain other things also, but these are some arguments which are very relevant and address the issue which is being faced by the taxpayers. So 16.4, in my opinion, first effort should be to comply with the provision, and if we are not able to comply with the provision, then 16.2 vis-a-vis 16.4, the non-obstinate clause of 16.2. Second, the notification which have been issued till 30th September 2019. And third alternative argument can be the restriction put in by the common portal. Now coming to Rule 36.4. I would not be going into the details of Rule 36.4 because we all are knowing it very well, and we have the provision is there since 9th October 2019. I would only be touching upon the two important issues in this Rule 36.4. First thing, when I read through Rule 36.4, it says input tax credit to be availed by a registered person. That is, Rule 36.4 is applicable on all the credits which have been availed by the registered person after 9th October 2019. Without going into the constitutional validity aspect, just understanding Rule 36.4, which is as it is, which is there in the statute, and reading it as a literal interpretation, it says ITC to be availed by a registered person in respect of invoices or debit notes, details of which have not been uploaded by the supplier under section 37(1) shall not exceed 10% of eligible credit available. In respect of invoice or debit note, the details of which have been uploaded by the supplier under subsection 37(1). So Rule 36.4 is applicable on the credit availed after 9th October 2019. There is one when I say to the term that the ITC to be availed by a registered person after 9th October 2019, it is not linking with any of the period for which the ITC is being claimed. It is linked with the fact that I am availing ITC, be it of any period after 9th October 2019. So there is one misconception that Rule 36.4 is applicable only after October 2019 returns, or with effect from the returns filed for the period October 2019. It is incorrect. It is applicable on any ITC, be it for any period availed after 9th October 2019. So if I am filing my return for March 2019 on 15th October 2019, it is hit by Rule 36.4 because I am availing ITC after 9th October 2019. If I am filing all the returns of 18-19 after 9th October 2019, I am hit by Rule 36.4. So therefore, in my opinion, whatever ITC which has been claimed after 9th October 2019 is hit by Rule 36.4. It is not that only ITC which has been claimed for returns of October 2019 onwards is hit by Rule 36.4. Had it been that, Rule 36.4 would have been drafted in a manner input tax credit to be availed for the period after October 2019. It is not saying so, it is only saying about availment, and any ITC, be it for any period availed after 9th October 2019, is hit by Rule 36.4. And this is also has been clarified by Circular number 123 dated 11th of November 2019, which says the restriction of 36.4 will be applicable only on invoice or debit notes on which credit is availed after 9th October 2019. Now there is one another thing which is associated with GSTR 2B. Now GSTR 2B says GST 2B is generated from 12th of previous month to 11th of current month and is applicable for the return to be filed for the previous month. So if I am filing return for October 20, GST 2B would be generated for 12th October 20 to 11th November 2020. And it would be containing details of all the GSTR1 which have been filed during that period. And government and also the circular says that whatever ITC which is there in GSTR 2B should be claimed in the return. So therefore, they have created a deadline of 12th of current month for the purpose of claim of ITC for the return to be filed for October 26. Now, this is not coming anywhere from Rule 36.4. Rule 36.4 only says that the ITC to be availed in respect of invoices which have not been uploaded shall not exceed 10% of eligible ITC in respect of invoices which have been uploaded. It does not say in respect of invoice or debit note which have been uploaded up to the due date of filing of return under section 37(1). This due date concept has been brought in by circular number 123/42/2019. It is not being brought by rule 36.4. So in my opinion, GSTR 2B restriction is not coming even from rule 36.4. Rule 36.4 only says that on the date when I am filing the return, the credit I am eligible to take in 3B is 110% of the invoices which are for which GSTR1 has been filed by the suppliers. It does not say, Rule 36.4 does not say that up till the due date of filing of GSTR1 for the relevant month. This is a concept which has been brought in by the government, and GSTR 2B, in my opinion, although it has been notified in the rules from 13th October 2017, still it does not restrict in any way claim of credit in Rule 36.4 because Rule 36.4 is not subject to the GSTR 2B or is not restricted to GSTR 1 filed up till the due date of the relevant month. This is coming out of the circular, and provisions of circular cannot override the provisions in the rules, leaving aside the act itself. So these are two issues which I would have liked for discussion on Rule 36.4, keeping in mind that Rule 36.4 is constitutionally valid. I have not touched upon the issue that whether Rule 36.4 is valid or not. Up till now, what I have discussed is presupposing that Rule 36.4 is constitutionally valid. So there are two issues. First, it is applicable on the ITC which is being availed after 9th October 2019, be it for any specific period, be it for any period. And second, the entire concept of 2B is not coming from 36.4 because it is no Rule 36.4 is nowhere restricting ITC only up to due date of filing of GSTR1. It is only saying claim to be 110% of ITC uploaded in 37(1), not uploaded up to the due date of 37(1). So this is the part wherein we were discussing that if Rule 36.4 is constitutionally valid, then what are the issues which we have to keep in mind? And what I have come across that if there are 100 assessees, in 95 assessees or 96 assessees, compliance of Rule 36.4 is not an issue. It is only those 3 to 4 assessees where compliance is an issue, and in those cases, if there need be, and if it is possible, we should challenge the validity of Rule 36.4 itself. And what are the issues surrounding the validity of Rule 36.4? First, we discuss Section 6. We have already discussed Section 16(2)(c), which says that's subject to the provisions of section 41 and section 43A. Now, what was section 43A? Section 43A(4) provided that the procedure for availing input tax credit in respect of outward supplies not furnished under subsection 3 shall be such as may be prescribed, and such procedure may include the maximum amount of input tax credit which can be so availed not exceeding 20% of the ITC available. So 43A(4) was somewhere on the lines of Rule 36(4). And that's why section 16(2)(c) was made subject to 43A, because 16(2)(c) presupposes payment of tax and 43A presupposes uploading of the invoice by the supplier even though tax has not been paid. So 43A was giving a hypothetical additional credit of 20% merely on the uploading of invoice by the supplier even though the tax might not have been paid by the supplier. And this was running contrary to section 16(2)(c). That's why section 16(2)(c) provision was made subject to the provisions of section 43A. But as the thing stands today, section 43A is not yet notified in the statute. And if the government thought fit that we would be giving additional credit by 43A, section 16(2)(c) should be subject to 43A. Then why the government has not brought similar provision for Rule 36(4)? Because Rule 36(4) is on the similar lines of 43A. And when section 16(2)(c) is made subject to 43A, can there be a situation that without 16(2)(c) being made subject to Rule 36(4), government can give additional credit to me of 10%? In my opinion, Rule 36(4) is a provision wherein the government, the revenue itself might challenge the validity of Rule 36(4). Take an example that your supplier has filed GSTR1 and it is being reflected in 2A. You claim the credit on the basis of 2A citing Rule 36(4). But the supplier has not deposited a tax and not filed GSTR 3B. Now the officer comes and says that since the supplier has not filed his 3B, you are not entitled to the credit. The taxpayer would say that Rule 36(4) enables me to claim the credit on the basis of invoice being reflected in GSTR 2A. The officer would say that I do not agree with Rule 36(4) because it is part of the rules. The law is subject to 43A and 43A has not been made effective, so I will go by 16(2)(c). The question is, if 43 is not there in the statute, how can a rule be made subject to section? Because rule is a part of delegated legislation. There should be an enabling section in the law, and on that basis there can be a delegated legislation. But if there is no enabling section, and the enabling section which was there in section 16(2) has not been enabled till date, how can a rule supersede the provisions of section? So the first thing is Rule 36(4) somewhere down the line contradicts itself with section 16(2)(c), and unless until there is an enabling provision, the rule itself cannot stand to the validity of the law. So now these are some questions which I have framed, or issues which I have framed, which are relevant for Rule 36(4). First, relevant provision under the Act empowering Rule 36(4) in absence of 43A. Now, if 43A is not there, what can be the enabling section for Rule 36(4)? Because something has to be there for a rule to be inserted in the rules. Whether it is 16 subsection 1, 16 subsection 1 says that a person would be entitled to take credit subject to such conditions and restrictions as will be prescribed. But then the question comes that if 16.1 was sufficient for bringing in Rule 36.4, why 43A itself was brought in the law? And secondly, even if 36.4 is coming from 16.1, then 16.2 is having an overriding impact on 16.1. So Rule 36.4 itself then goes underneath section 16.2 and loses its relevance in the statute. And if 16.1 is not sufficient, then whether it is supported by section 164, which empowers the government to bring in the rules for the proper enforcement and applicability of sections in the statute. Something which has helped the government in Rule 117, validity of Rule 117, which provides a time limit for filing of Tran 1. Even though the parent section, the enabling section under section 140 does not provide that within such time as may be prescribed. These words are missing in section 140, that within the time as may be prescribed, still the validity of Rule 117 has been upheld, citing section 164. So can section 164 comes to the rescue of Rule 36.4? The entire thing revolves that if 16.1 or 164 were sufficient, then what was the need to bring in 43A? And if 43A cannot be enforced, there cannot be a backdoor entry for Rule 36.4. And if Rule 36.4 itself is held constitutional, say for a moment, GST at 2B cannot hold even if Rule 36.4 is constitutional, because 2B is being generated on a particular date which is not even prescribed in Rule 36.4. So first there are reservations for 36.4 itself, and more than that there are much more reservations for 2B there, 2B also. Second issue, genuine inward supplies cannot be denied benefit of ITC. We have discussed it at length while discussing section 16.2c. How recipient can be made responsible for supply not depositing the due tax. This we have also discussed while discussing section 16.2c. Mechanism available to the recipient as and when section 43A would have been applicable, not yet brought in place. When 43A would have been brought in place, there would have been ANX 1, ANX 2, there would have been Sahaj, Sugam. There would have been mechanism wherein the recipient can claim the ITC on provisional basis and inform the supplier to deposit the tax. That mechanism has not yet found place when 36.4 has been brought in the statute, brought in the CGST rules. So without such mechanism, which the legislature deemed fit while bringing in section 43A, without such mechanism, how can a piece of delegated legislation be brought in the statute, be brought in the rules? Next, section 16.2c, section 16.4 vis-a-vis rule 36.4. Now there are three situations. 16.2c, which says credit should be available when the tax has been paid. 16.4, which says that credit should be available within the specified time limit. And Rule 36.4, which says that the credit should be available only if the supplier has uploaded invoice in 2A. And supposedly, if the supplier uploads the invoice after the due date of claiming the credit under 16.4, whether mere fact that the supplier has uploaded GSTR1 after the prescribed time limit in 16.4 can deny the right to claim the credit within the time limit. When I am entitled to claim the credit on the basis of tax being paid by the supplier, having the requisite invoice, having received the goods or services, merely because the supplier has filed his GSTR1 late, and I cannot claim the credit because it has been filed after 20th October 2020, can Rule 36.4 override 16.4? So the entire mess has been created by 16.2c, 16.4 and 36.4, where each and every provision are competing within themselves. And if I see logically how the things may plan out, 16.2c might be read down for the genuine purchasers. 16.4, in my opinion, is 16.2 is being overridden by 16.4 is being overridden by 16.2 because 16.2 is having a non-obstinate clause for anything contained in section 16, and rule 36.4, in my opinion, stands on a very weak ground because it does not have a support of an enabling legislation. So this is how we can understand the implication of 16.2c being read down for genuine purchaser, 16.4 being overridden by 16.2, and rule 36.4 still searching it for its parent legislation. Since 43 has not been notified till now. Had 43A been notified and 36.4 would have been there, then 16.2c would have been subjected to 43 and 36.4. And last but not the least, legal precedents laid down in VAT regime. We have discussed two decisions. There are many more decisions for pre-GST regime, but these two decisions, the RS transmission or Arise India, these are decisions wherein the language of the statute in VAT was similar to the one in GST. So, in my opinion, these are the grounds on which 36.4 can be challenged and is having somewhat a weaker ground to stand upon. But again, it is for them who can go and challenge the rule. If I cannot follow the rule, I should challenge the rule, but I should refrain myself in adopting a middle approach because that may leave the assessee with imposition of penalties, and he might have to travel to the High Court or the higher courts with amount to be paid for pre-deposit of appeal or subsequent enforcement measures being adopted by the department. Now coming to section 50. Now this is a brief 10 minutes discussion, then we will be moving up on QRMPS, quarterly and monthly payment scheme. It is now known to us that an amendment has been made in section 50 which provides for payment on net tax liability to be paid. We would not be discussing and going on to the legislative history or payment of interest on gross tax because in my opinion that thing has been settled down by the GST Council and then the instruction by the CBIC. However valid that instruction is, but since it is an instruction by CBIC, it is having a binding precedent on the officer. Therefore, nobody would be going against that instruction. So we will not be discussing that part. What I am discussing and what I intend to discuss is the language of the proposed amendment, which will be notified later on. What it says is, provided that the interest on tax payable in respect of supplies made during a tax. See, just try to understand what this proviso is saying. Provided that the interest on tax payable in respect of supplies made during a tax period and declared in the return for the said period. That is, supplies which have been made during a tax period and has also been declared in the return for the said period, furnished after the due date in accordance with the provision of section 39, shall be levied on that portion of the tax that is paid by debiting the electronic cash ledger. So there are two conditions associated with payment of tax, payment of interest on amount debited from electronic cash ledger. First, supplies should have been made during a tax period, and secondly, they should have also been declared in the return for the said period. If they are not declared in the return for the said period, then they would not be eligible to claim benefit of this proviso. So take an example that I have made certain supplies, say in the month of July 2018. of say 1 lakh rupees, I have in my electronic trade ledger balance of say 2 lakh rupees. Now, I filed the return for July 2018, say in the month of September 2019. And all the supplies of 1 lakh has been duly reflected in that return, even though it has been filed after 14 months. Now, since all the supplies of 1 lakh of July 18 have been properly reflected in the return of July 18, although filed in September 19, but I had sufficient ITC, therefore I would not be liable to pay any interest, even though return has been filed belatedly. But take another case that I have an output liability of 1 lakh rupees in July 18. I have an ITC balance of 2 lakh rupees. But out of that 1 lakh, I only declared 60,000 rupees in July 18. And that return has been filed well within time, say on 15th August 2018. And the rest of the 40,000 are declared in the return for the month of March 2019. Now I have made certain supplies in July 18, but I have not declared those 40,000 rupees in the return of the said period. That 40,000 has been declared in the return for the month of March 2019. Now, since the twin conditions, that the supply has been made and declared in the same return, has not been fulfilled, therefore, in that case, I would be liable to pay interest on those 40,000, even though I had sufficient balance in my credit ledger. So we have to be very careful while filing return, because if certain supplies have been shown with delay in subsequent returns, even though the person was having sufficient balance of ITC, then also the assessee would be liable to pay interest and he would not be having the benefit of the proposed amendment. And this is clearly coming out of the agenda of 31st GST, minutes of the GST Council meeting and the agenda thereof, which said that the issue was deliberated by the law committee in its meeting held on 15 December 2018. The committee observed that the proposal to charge interest only on the net liability of the taxpayer, after taking into account the admissible credit, may be accepted in principle. Accordingly, the interest would be charged on the delayed payment of the amount payable through the electronic cash ledger. However, where the invoices / debit notes have been uploaded in statement pertaining to period subsequent to the period in which they should have been uploaded, the interest shall be calculated on the amount of tax calculated on the taxable value from the date on which the tax on such invoice was due. This would require amendment to the law, and the amendment has been made, although not made effective. So, while doing the GST audit or while filing the returns, we have to be very or careful about the supplies to be reflected in the correct month. Return might get delayed by 10 days, but I should reflect the correct supplies, because deferment of reflection of supplies in GST return, even though the assessee might have sufficient credit balance, might result in levy of interest, which will having a substantial financial impact on the position of the assessee. So this amendment, what is the general perception? I thought it fit to discuss along with the ITC part, because it is not as if I have sufficient balance in ITC, I can declare the supplies according to the month in which I feel them fit up till September of next financial year. It is paramount to reflect the correct supplies in the correct return to save on the interest liability. Now, this was the entire part of input tax credit, section 16.2c, 16.4, rule 36.4 and section 50. Now, coming to the quarterly return and monthly payment scheme. See, as we all know, that the compliance burden in GST is very high. Even a small dealer is required to file monthly returns 3B, and GSTR 1 are required to be filed quarterly if the supplies are less than 1.5 crore and monthly if the supplies are more than 1.5 crore rupees. But since now the ITC has been linked with GSTR 2A, so most of the smaller suppliers who are making supplies of B2B have opted for monthly filing of GSTR 1. Now this compliance part was posing challenge to the taxpayers. So what I can say is presently we are having monthly return monthly payment scheme, MRMPS. Now what the government has sought to brought is quarterly return monthly payment scheme, wherein payment would be delinked with the filing of return. And payment would be made as per the dates prescribed in the law, and return would be filed on a quarterly basis. And this was something which was being asked by the trade and the professionals from the starting as well. That delink the payment from the filing of return. The problem is that you have linked the payment with the filing of return. And this was the issue which was being faced by the taxpayers in pandemic as well. They did not have the accountant to ascertain the correct liability, because you cannot file a return merely on the basis of estimates. But yes, you can deposit the tax on the basis of estimate to save on the interest. But the problem is that the GST was linking payment with filing of return, and since payment with filing of return was linked and it was on a monthly basis, the small dealers were facing an issue. So what they have done is delink the filing of return with from the payment of taxes. What are the relevant notifications? See, again, what they have done is, first amendment in the statute has been notified. The amendment in 39, 1, 2 and 7, wherein they have been enabled to provide the procedure for filing of return, provide the procedure for payment of taxes. That has been enabled by notification 81/20 Central Tax dated 10th November 2020. Once the statute has been amended, relevant amendment has been made in the rules as well. Then notification number 84/2020 Central Tax provides and notifies the persons who would be filing return under proviso to 39(1), that is quarterly return monthly payment scheme. And notification 85/20 notifies special procedure for making monthly payment of taxes for the first 2 months of the quarter, wherein if a person is depositing tax in the cash ledger, it would be treated that the liability has been discharged by him, and he would be saving upon the interest cost if leviable had the payment of taxes would not have been delinked from filing of return. So what was the decision of GST Council meeting? It was recommended in 42nd GST Council meeting that the persons who are having an aggregate turnover of 5 crore rupees in the preceding financial year may be allowed to furnish return on a quarterly basis with monthly payment of tax. So this was a decision of GST Council meeting, and implementation and legislative changes were left upon the government and the administration. So what this scheme offers? This scheme offers that you can pay monthly taxes and file returns quarterly. What would be the effective date of the scheme? It would be 1st January 2021. Now, who would be eligible for opting this scheme? Any person who is required to file his return in GSTR 3B, that is, all other persons who are not required to file return in 3B are not eligible for this, and they would have to continue filing their return. That, like the ISG or the TDS person, they would be continue filing their returns as per the present scheme. And second, the person who has an aggregate turnover of up to rupees 5 crore rupees in the preceding financial year. So if I am filing 3B and my turnover in the preceding financial year is less than 5 crore rupees, then I am eligible to opt for quarterly return monthly payment scheme. But there is an additional catch attached to it, that even though my turnover in previous financial year was less than 5 crore rupees, but if it has exceeded 5 crore rupees in the current financial year, I cannot opt for quarterly return monthly payment scheme. Or if after opting for quarterly return monthly payment scheme, my turnover crosses 5 crore rupees, then I have to opt out of the scheme. So three things I have to see. First, whether my turnover in preceding financial year was less than 5 crore rupees. If yes, I can opt for QRMPs. Second, when I am opting, in addition to checking the previous turnover of previous year, I have to check that whether as on date of option, my turnover is less than 5 crore rupees. If yes, then I can opt for it. And once I have opted, and if my turnover crosses 5 crore rupees, then I have to opt out of the quarterly return monthly payment scheme. So this is a broad understanding of the conditions which are required to be followed for availment of benefit in this scheme. And when the term is used, aggregate turnover of 5 crore rupees, it is having the same meaning as has been given under section 2 subsection 6 of GST Act, that is turnover on the PAN. It is not turnover on the registration. Now, when the option can be opted for? What is the time limit when the option can be opted for? So first, we have to go through a specific provision, that is a person who has opted for registration during the quarter, or a person who has opted out of section 10, that is composition scheme. They would be entitled to opt for this option based on the eligibility which is there as on the date of exercising the option. And how the eligibility is to be calculated? The eligibility, any registered person can opt for QRMPS from the first day of the second month of the preceding quarter to the last day of the first month of the quarter. So supposedly, if I am a registered person and I want to opt for QRMPS, say for the quarter of April 21 to June 21, I would not be choosing January 21 to March 21 because there are two issues involved in it. For the sake of simplicity, I am discussing that I want to opt for QRMPS from April 21 to June 21. So I can opt for that period from 1st February 2021 to 30th April 2021, and during that period, if I opted, then I would be entitled to file quarterly return and pay taxes monthly from 1st of April 2021. An example has been given in the circular as well, that a registered person intending to avail of scheme for the quarter July to September can exercise the option during the 1st of May to 31st of July. If he is exercising his option on 27th July of the quarter, then he is entitled to file return on a quarterly basis from July month. But in addition to that, when he is opting for quarterly returns, say on 27th of July, he also has to ensure that he has filed his returns up to the month of June. If he has not filed returns up to the month of June, he cannot opt for quarterly return monthly payment scheme from July onwards. So on an overall basis, if I see that how can I opt in normal scenarios, leaving aside January to March 21, supposedly I have to opt for say I have to opt for say July to September 2021. My time period is I should have opted for quarterly return monthly payment scheme from 1st of May to 31st of July. And whenever I am opting, my last return due should have been filed as on the date of exercising the option. So if I am opting for quarterly return monthly payment scheme on 27th of July, for the period July to September, my return till June should have been filed. If my return till June has not been filed, that option would not be activated. So whenever I am opting for a quarterly return monthly payment scheme, two things has to be seen, that I am opting in the correct period, that is 1st of May to say 31st of July, and my previous returns due up till the date of exercising option have been filed. Once opted, I am not required to opt for every quarter. Next, supposedly I am registered in 6 different states. I can opt for QRMPS in 4 states, and I can not opt for QRMPS in the rest of the 2 states. It is not unlike the composition scheme that if one registration in composition scheme, rest of all the registration would also be in composition scheme. A person can opt for QRMPS on GSTN wise basis, that he can opt for some GSTN, he might not opt for rest of the GSTN. So this was a discussion what would be happening after April 20 supposedly. But what I need to do for the purpose of opting for QRMPS or not opting for QRMPS from 1st of January 2021. And somewhere down the line I see that simplified things which have to be brought in GST in a simplified manner are not brought in that manner. Some complications, some hurdles are somehow inculcated in the law that taxpayers are not able to take the benefit of the simplified scheme. So what they have done is, first they have made a cutoff date that taxpayers who have filed their return for October 20, who have filed the returns for the period of October 20 up till 30th November 2020 are the first category of taxpayers. And taxpayers who have not filed return for October 2020 by 30th November 20 are the second category of taxpayers. Now for the taxpayers who have filed their return up to 30th November 2020, they have prepared 3 default options. First default option is, that is, they would be automatically migrating that taxpayer as per the default option. And what is the default option? Supposedly, I am a person who is filing GSTR1 on a quarterly basis. So the system would be directly taking me to a quarterly return monthly payment option. I need not opt it manually on the system portal. The system would by default take me to quarterly return option. If I am filing GSTR1 and my turnover is less than 1.5 crore rupees and my filing periodicity of GSTR1 is monthly, although I am entitled to file quarterly, but I have opted for monthly filing of GSTR1, even though my turnover is less than 1.5 crore rupees, the system would by default take me out of QRMPS and they would keep me in monthly return monthly payment scheme. Third, all the taxpayers who are between 1.5 to 5 crore rupees, they would be taken to quarterly return scheme. So there are 3 options, default options by which the system has categorized the taxpayers and made a default option for them. If the person has filed return for October 20 by 30th November 20 and he is filing quarterly GSTR and having turnover up to 1.5 crore rupees, they would be taking it quarterly option. Registered person having a turnover up to 1.5 but filing GSTR on monthly basis, monthly return option, they would not be given a default option of quarterly return monthly payment scheme. And third, persons who are having a turnover between 1.5 to 5 crore rupees, they would be given a default option of quarterly return monthly payment scheme. Now, this is a default option being given by the system. If I want to change it, I can go and change it on the portal between 5th of December to 31st of January 2021. So supposedly my turnover was less than 1.5 crore rupees, but I was filing GSTR 1 monthly basis. System has given me a default option of monthly return, but I want to go into QRMPS. Then I would be required to go on the portal from 5th of December to 31st January 2021 and then select the quarterly return monthly payment option. If I would not be doing that, the system would automatically take me out of the quarterly return monthly payment scheme. Or supposedly my turnover is less than 1.5 crore rupees, but I am filing GSTR 1 on a quarterly basis. So system would by default take me to QRMPS. But I want that even though QRMPS is there, but I do not want to opt for QRMPS. I want to file my GSTR 1 monthly and 3B monthly. I would have to go on the portal between 5th of December to 31st January 2021 and opt out of the scheme. So it is very dangerous where a default option has been given by the system to not to ascertain what is the option which the assessee wants to opt. Because there might be a case that the system would have by default taken to an option and assessee wants to opt otherwise. So this is the first case which is there for the persons who have filed their return for October 20 by 30th November 2020. Second is the case the person who have not filed their return for October 2020 by 30th November 2020. In that case, they would be required to go on the portal between 5th of December to 31st of January and select quarterly return monthly payment option, and after that they would only be able to opt for the scheme. If they do not do so, then they would not be in the scheme, they would be out of the scheme. But the condition is whenever they would be opting for the scheme, they would have to file all the due returns which are all the returns which are due as on date of opting for the scheme. So as a professional, what I have to do is I have to segregate my clients between who have filed up to 30th November 20 and who have not filed returns up to 30th November 20. Then I have to see what is the default option which has been given by the system, and if the default option is given by the system and assessee is agreeing to it, then nothing to do. But if the assessee wants to do otherwise, then opt out of the scheme or opt in the scheme. And secondly, in cases where the return has not been filed, first file the due returns up to the date of filing of option and then see what is the correct option we have to opt. If it will not do anything, then system will keep you in the monthly return monthly payment scheme. System will not take you to quarterly return monthly payment scheme. But whenever you are opting in the scheme, or the system is adopting a default option for making you opt in the scheme, you have to see that your turnover should not have crossed 5 crore rupees. If your turnover would have crossed 5 crore rupees and supposedly the system by default has taken you because your turnover was less than 5 crore rupees in the previous financial year, and system has by default taken you to a quarterly return monthly payment scheme. But up till January 2021, up till December 2020, your turnover crosses 5 crore rupees. Then in such case, you would have to opt out of the scheme. Because as on the date of exercising the option, your turnover has exceeded the threshold limit of 5 crore rupees. And that has also been clarified in the circular. It is reiterated that any taxpayer whose aggregate turnover exceeded 5 crore rupees in the financial year 2021 shall opt out of the scheme. So there needs to be a flow chart being made for you. Filed up to November 20, not filed up to November 20. What is the default option? Whether in case the default option is opted for quarterly return, whether the turnover of client has exceeded 5 crore rupees. If yes, then opt out of the scheme. If no, then ask the client whether they want to go for QRMPS. And in case the returns have not been filed up to 30th November 20, file the returns, opt for the option, but while opting for the option, see that your aggregate turnover has not exceeded 5 crore rupees in the current financial year as on the date of opting for the QRMPS. Voluntary opt out of the scheme. If I want to opt out of the scheme, supposedly I have opted in for the scheme from January 2021. Now, after opting, I see that I am not getting the required benefit, so I need to opt out of the scheme. So for opting out of the scheme, I can only opt out for the next quarter. For this quarter, I would be in the quarterly return monthly payment scheme. And for opting out of the scheme for the next quarter, the option would have to be exercised. Say for the I want to opt out from April 2021. So I would have to exercise the option from 1st of February to 30th of April for opting out from April 2021. This is the same time limit which was there for opting in same time limit for opting out. So even if a taxpayer wants to opt in, he has to opt in between the period 1st of February to 30th April 2021. For starting from 1st April 2021, and if he wants to opt out from April 2021, he has to opt out between 1st of February to 30th of April. This is a voluntary opt out of the scheme. Now there is a compulsory opt out of the scheme also, that supposedly a person opted in, say for financial year 2021 from 1st April 21 in the QRMPS. Now on 31st of August 2021, his turnover crossed 5 crore rupees. So from 31st of August to 2021, he would have to opt out of the scheme, and once he opt out of the scheme, he would be required to file monthly returns from October 2021, because he is in the scheme for the period July to September. Now since he has exercised the option on 31st August 2021, and that is a relevant period for opting out for October 2021, because opting out for October 2021 was the period from 1st of August to 31st of October 2021. Since he opted out during this period, he would be taken out of the QRMPS from 1st of October 2021. So this was a scheme for opting in and opting out of the quarterly return monthly payment scheme. Now, once I have opted for quarterly return monthly payment scheme, I would be required to file my GST on a quarterly basis. I cannot opt for a quarterly 3B and a monthly GST. For a quarterly 3B, there would be a quarterly GST. And once there is a quarterly GST, so there might be cases, because now this scheme is covering dealers up to having a turnover up to 5 crore rupees. These are not small dealers up to 1.5 crore. These are large dealers on 1.5 crore rupees. They are largely having turnover up to more than 1.5 but less than 5 crore rupees. So much larger people are there in this QRMPs. So what government did, to the best of their understanding and to somewhere more complicate the law and compliance, they did not allow filing of GST on a monthly basis. They said that we would allow you to file GST on a quarterly basis, but you would be allowed to upload invoices of B2B as a IFF, invoice furnishing facility, for a particular month between 1st and 13th of the next month. So supposedly I have opted for QRMPS from January 2021 and I have 20 B2B invoices in January 2021. And I want that this credit should be transferred to my recipient because it would be reflecting in GSTR 2B. And if it would be reflecting in GSTR 2B, then only you would be able to claim the credit. So what I do is I opt for IFF. And for those 20 invoices, I furnish the details of those invoices between 1st of February to 13th of February. And for say February 2021, I furnished the information from 1st of March to 13th of March. So that credit would be reflecting in their GSTR 2B. But while filing GSTR 1 for January to March, I would have to exclude those invoices which have been uploaded in IFF. So supposedly there are 20 invoices for January, 20 invoices for February and 20 invoices for March, and I am filing my GSTR 1 on a quarterly basis, and out of those 60 invoices I have already uploaded 35 invoices of January and February. So while filing GSTR 1 on a quarterly basis for the quarter January to March, I would have to exclude those 35 invoices by GSTR 1 and upload rest of the 25 invoices. How this would be done is again a challenge for the taxpayer, because till now and almost in the near future there would not be any software which would be giving this facility that these invoices have been uploaded in IFF and these invoices have not been uploaded in IFF, and we are generating the GSTR1 only for the invoices which have not been uploaded on the IFF. It's simple to think upon while sitting far from the dealer, but when you sit on the desk of the dealer, it becomes a tough task to identify those invoices which have been uploaded in IFF and which have not been uploaded in IFF. So effectively, if I'm going for quarterly return monthly payment scheme and my majority of dealers are B2B supplies, then I would have to opt for IFF. And if I'm not opting for IFF, my recipients would not be dealing with me because my ITC would not be traveling to them. So in majority of cases where there are B2B invoices, then in my opinion, most of the people would not be opting for QRMPS. They would be going for monthly return, monthly payment scheme, even though their turnover might be less than 5 crore rupees, because filing of details in IFF and then matching with GSTR1 and then uploading the detail is somewhere equivalent to filing GSTR on a monthly basis along with GSTR3 on monthly basis. Further, there is another cap that any person who opts for QRMPS and uploads his invoices on a monthly basis in IFF cannot upload invoices more than 50 lakh rupees per a month. So if I have opted for IFF, opted for QRMPS, my invoices being uploaded in IFF for a particular month cannot exceed 50 lakh rupees. So there is a capping of per month of 50 lakh rupees for uploading invoices in IFF. How they have thought so? Because they have thought that each business runs across similarly in all the 12 months, and since it runs across similarly in the 12 months, there would not be any month wherein more than 50 lakh of there would be more than outward there would be an outward supply more than 50 lakh rupees for B2B invoices. But this is again an idealistic scenario. There are many seasonal trades which we know in our region, which only operate from the period July to November. And although their turnover is less than 5 crore rupees, but the entire sale is made in those 3 to 4 months. So how this IFF would be working upon, and how the people would be able to cope it, and how the software vendors would be able to cope it is another challenge. And whenever we are guiding any person to opt for IFF, opt for QRMPS, we have to acquaint them regarding the shortcomings of IFF. A person who is making an export sale would not go for QRMPS, because his GST would be going on a quarterly basis, and if he is making exports against IGST, he would be denied refund for at least 3 months. So QRMPS is good, the intention is good, but the limitations, the restrictions, and the complications of opting in, opting out, and filing of IFF, and then excluding those invoices from GST is a challenge with which the assessee needs to be acquainted with before opting in for QRMPS. Now, applicability of late fees is the same, which is there. If the return is not filed within the by the due date, then similar late fees as is prevalent now would be applicable. Is there any late fees for delay in payment of tax? There is no late fees for delay in payment of tax, uh, because I am required to pay tax for the first 2 months, and then I have to file 3B. So if I am paying tax late through PMT 06, there is no late fees. Just like there is no late fees for CMP 08 in case of composition dealers. Similarly, there is no late fees or delay in payment of tax, only interest would be there. Now, we have discussed opting in and opting out. We have discussed filing of outward supplies. Now we have come to the last part, that is payment of taxes. Again, an option is there. Somewhere down the line, GST, the administration in GST are obsessed with option. They put in the option to opt. Nothing is without any option. You have to file GST, there is an option. Filing monthly or a quarterly. You have to, there are many scenarios wherein there are options to be exercised, and if such options are not exercised by this due date, you would be gone to this, and if it is exercised by this date, you would be doing this. So now again there is option in payment of taxes. First, the due date of payment of tax, it is 25th day of the month succeeding the month. So if I have opted for QRMPS for the initial 2 months of the quarter, supposedly for say January to March 2021, for January and February, I would be required to pay tax respectively on 25th of February and 25th of March in GST PMT 06. This is the first aspect. Now while making the payment, I have to select the challan monthly payment for quarterly taxpayer. The option has to be selected while making the payment under QRMPS, that I am making the payment for monthly payment for quarterly taxpayer. And once a payment has been made using this facility, I will not be allowed to use this payment for any other purpose otherwise than for using it for 3B. So supposedly I have made a payment using this option for January, that amount would be freezed. I made additional payment for February by 25th of March, this payment would be freezed again. Now, while I am filing 3B, my liability is supposedly in cash is less than what I have deposited in first 2 months, because there might be a case that there would be availability of ITC in March. Then in such case, supposedly I have deposited 100 rupees, but my net liability due to excess availability of ITC in the month of March is only 50 rupees. That cash available in cash ledger is 100 rupees, but my cash to be discharged for the entire quarter is 50 rupees. So rest of the 50 rupees would be free after filing of GSTR 3B, and then I can either use it for subsequent liability or I can claim refund of that amount, but that is only possible only after filing of GSTR 3B for the relevant quarter. Now there are two methods for paying the tax. First is the fixed sum method. Now what this fixed sum method says, there are two examples which I have given in the circular also. Supposedly, I have to deposit the tax, say, for the month of April to June 2021. And for the period up to March 2021, that is January to March 2021, I was filing my GSTR 3B on a quarterly basis. So, if my total liability for the quarter was say 100 rupees, 100 rupees in SGST, 50 rupees in IGST and 50 rupees in cess. Not the total liability, individual headwise liability. In SGST totaling to 100, CGST totaling to 100, IGST totaling to 50 and cess totaling to 50. I would be required to deposit 35%. That is, this liability is which has been discharged in cash for the previous quarter. Not the total output liability, in cash for the previous quarter. So I would be required to deposit 35% of this liability in the month of April, 35% of this liability in the month of May, and rest of the entire liability on a quarterly basis while filing GSTR 3B. So if my total liability in SGST for the quarter January to March 2021 deposited in cash is 100 rupees, I would have to deposit the challan of 35 rupees in SGST for April 2021. If my CGST liability was also 100, I would be required to deposit CGST 35 rupees on April 2021, IGST 50 rupees, IGST 50 rupees, then 17.5 for April 21 and 50 rupees cess in 17.5 for April 21. And similar challan would be auto generated for May. So what the government is saying, that the first option is that whatever is your liability in the previous quarter, we would be self-generating challan of 35% in the month of April, 35% in the month of May, and for the month of March, you can deposit the tax while filing 3B on an actual basis. So a deemed calculation method has sought to be inserted by the government for fixed sum method. Now supposedly I opted for QRMPS from April 2021. Up till March 2021, I was filing my 3B on a monthly basis. Now what they will do, they will take the cash liability deposited in the month of March as the base figure. And that amount has to be deposited for the month of April. Equally, that amount has to be deposited for the month of May. And while filing the 3B for April to June, I can ascertain my correct liability and pay off my liability using the balance available in the cash ledger which I have deposited in the earlier 2 months. And if required, put in additional amount. If not required, I can use whatever amount required and leave the balance amount in the cash ledger. So if I opt for fixed payment scheme, I would have to see what was the periodicity of filing of my previous quarter. If my previous quarter was a quarterly basis and I opt for fixed sum method, then 35% would have to be deposited in first month, 35% in second month. This is on a provisional basis, and this amount would be lying in cash ledger. While filing 3B, I can utilize this amount to the extent required, and if it is short, I can deposit additional amount and then file my 3B. And if some amount is left after filing 3B because I deposited 70% in cash but my liability was not so, I would be able to claim the refund of rest of the amount lying in the cash ledger. Now supposedly I was required to deposit 35. Now my liability in previous quarter was say 100 rupees. I opted for fixed sum method. I deposited 35 rupees in April. I deposited 35 rupees in May. But when I filed my GST 3B, actual liability for April was 42 rupees and actual liability for May was 40 rupees supposedly. Whether I would be liable to deposit interest for the balance amount which has been short deposited by me. In this case, government says that since you have opted for a deemed method of 35% of liability to be deposited on the basis of previous liability, we will not be charging any interest from you if you deposit your 3B by the due date. So, if supposedly for April I have deposited 35 rupees, or May I have deposited 35 rupees, but my actual liability was 42 rupees for April and 40 rupees for May. But I deposit my 3B for July up to 24th of July, say. My 3B for June up to 24th of July. I would not be required to pay interest on the difference liability of 7 rupees and 5 rupees. But if I deposit my return after delay, after the due date, then I would be required to deposit interest on the amount which was required to deposit on a monthly basis, even though I opted for a fixed sum method. And secondly, I would be required to deposit interest for the period of delay in filing of return as well. So there would be two types of interest which I would be paying. First, the difference between the actual liability and the deemed liability, and second, the delay in filing of the return from the due date. But if I would be filing my return by the due date, I would be saving on two interest. Since I have opted for a deemed method, no interest would be levied upon me for the shortfall as vis-a-vis the actual liability. And secondly, there would be no interest because I would have filed the return by the due date. So, if a person is opting for a fixed sum method, then he has to ensure firstly that he deposits the tax by the due date, and secondly more importantly he deposits the return by the due date. Because if the return is not deposited by due date, he would be required to pay interest on the shortfall of the tax which was not deposited by him. Secondly, take a case that I was liable to deposit 35 rupees for April and 35 rupees for May. Although I deposited my GST 3B by 24th, but I deposited those two tax via delay of say 5 days. For 25th of for April month, which was required to be deposited by 25th of May, I deposited by 30th of May. For May month, which was required to be deposited by 25th of June, I deposited by 30th of June. But I deposited my 3B by 24th of July. Now, in such case, I would not be required to deposit interest on the actual difference between the actual liability and the deemed liability. But I would be required to deposit interest for delay in payment of the 35% liability. So while opting for monthly, quarterly payment, quarterly return monthly payment scheme and fixed sum method, we have to be very careful that the tax of 35% should be deposited by due date and the return should also be deposited by due date. Otherwise, there might be multiple calculations involved for the purpose of levy of interest. And also calculation of interest is not an easy thing, but in this scenario, a dealer would be liable to calculate interest in multiple methods. Now this is a fixed sum method. Now the alternative method is self-assessment method. What you do is you ascertain your output liability, you ascertain your input tax credit, you arrive at the difference between the two and pay the challan by 25th of the next month. And similarly for the month of May and for the month of June, you file your 3B by the due date. So this is the self-assessment method. The fixed sum method is would be beneficial for the persons who have a large amount of liability to paid in cash, and on the basis of previous liability, auto-generated challan would be available to them. But in cases where there is a fluctuation between the credit available and the tax to be paid, in such cases, fixed sum method would not be a advisable method. Because if the credit fluctuates, then and I'm opting for a fixed sum method, I would be depositing 35% for the initial 2 months, and the huge amount of credit is available in the month of say June, then I would be left with my excess balance in the cash ledger, which either I can use it for future payments or I will have to claim the refund in such cases. But where there are huge cash liability, a fixed sum method would be helpful in saving on the calculations to be made. Method for generating of challan, this I have already discussed through an example. Quarterly filing of GST or 3B, it would be filed for each quarter before 22nd or 24th of the month, as the case may be. And in case registration is cancelled, then the person would be required to file the return on a quarterly basis for the period during which his registration was active. So this is all about the quarterly return monthly payment scheme. What I would like to say is this is one more instance where much more has been deliberated through the circular rather than the substantive provisions of the statute or the rules. And many things are coming from the circular. One thing which is coming through the circular only is that once I have deposited an amount in cash ledger, I would not be able to use it up till I file my GSTR 3B. Now this is a provision which is neither coming from the rules and nor coming from the notification. This is a restriction which is not there in Rule 87 of the CGST rule, nor in the notification prescribing the special mode of payment. It is coming from the circular which has been given by the board. So we have to be very careful that merely by reading through the statute and the rules, we would not be able to acquaint ourselves from the modalities which have been brought from the circular, and somewhere down the line, circulars are playing a pivotal role in implementation of the law and sometimes going beyond the provisions of the law. And opting or not opting for QRMPS, opting for fixed sum method or not opting for fixed sum method, opting for IFF and not opting for IFF is a thing which has to be discussed in detail with the client. His pros and cons have to be discussed, and then only the option has to be availed. We cannot make a thumb rule that since your turnover is less than 5 rupees, go for QRMPS. There might be 90% B2B supplies, and filing of IFF and subsequent filing of GST1 might be a challenge in those cases. So this is all about my topic on input tax credit and section 50 and the QRMPS, and I hope that I would have been able to do justice with the topic, and thank you very much for giving me the opportunity to share my views on the subject. Thank you very much, Bhutraji. Thank you very much, all the members of Tax Bar Association. Thank you once again for a patient hearing. Thank you, sir. I hand over the session back to the host.
Thank you, Haldia ji. Mitesh, please take over for questions.
Yes.
If any, very few, because I too have few questions.
Please go ahead, sir.
President sir, I too have 2 questions. I already booked with Arpit before commencing the session itself.
Yes, please proceed, Amrut. You have the first priority.
Is there any remarks to be from secretary to be given, or can I proceed for the asking questions?
You can proceed, sir. You can
Proceed
proceed,
and please
please.
be brief because already time is over now. So please be brief.
I will ask brief only, but I don't know how Arpit will explain me. And so,
If he
but
is
it is
unable to understand, you can obtain his address.
See, okay, sir, it's more or like practical questions what I have faced during my 7 GST audits, sir. So one thing, one of my client is having the rock crushing unit. He is paying 5 crores of royalty to the government of Telangana. So of course RCM will be applicable. But the in the initial days, now he is following that. But in the initial days, what he has done is he is paid on forward charge at the rate of 5%. Okay, and then now in the audit, what they are telling now, since it comes under the RCM and there is no rule for the paying of the forward charge, so they are levying the RCM on that, and plus interest and whatever is this. See, my straight question is whether this RCM can be taken as an input credit if you are paying now. That is the first question. Second question, if I am not getting any credit now, what about my forward charge paid amount? Because I already paid to the government as a GST. I need the clarification, but these two questions, sir. I have another questions, but I don't. I want to restrict only with these two questions.
Sir, these two questions are one of the most asked questions in most of the seminars. And if we go by the literal interpretation, then section 16(4) casts a restriction.
Yes.
But if we go through rule 36(1)(b), it says in case of RCM, the credit can be claimed as per the invoice issued under section 31(3), that is a self-generated invoice subject to payment of tax.
Subject to payment, doctor. Okay.
Subject to payment of tax. So unless
Sorry for the interruption. It means now, suppose if I am paying now, can I get input credit now?
yes, on that point I am coming, that my document would be valid not only by means of issuance under section 31(3), it would be valid on when I pay the tax, because subject to the payment of tax has been mentioned there. So my document would be a valid document for section 16(2)(a) when I make the payment of taxes. And when I am making the payment of taxes and in this year, so by virtue of 16(2)(a), my condition would be fulfilled in this year. And since my 16(2)(a) condition would be fulfilled in this year, even though section 16(4) time limit has expired and 16(2) is having an overriding impact on 16(4), I am eligible to claim the credit in the current year, subject to the time limit whichever is there. So the first argument which you should be taking and which we are also taking and most of the people are taking and has been discussed at length on various platforms is that rule 36(1)(b) says subject to payment of tax, and since tax has been paid in this year, my eligible document is also in this year, therefore I am eligible to claim credit in this year only.
But this case is of the 2 years back, sir, because audit now it is a 16-17 audit.
No, sir, still you would be paying the tax in the current year.
Yeah, current year I'm paying. Now I'm paying the tax, sir.
So your valid document would be the current year document.
Okay, right.
Therefore,
Thank you
the
very
credit
much.
will be availed in this year also. And second scenario which you can claim is the revenue neutral impact, because had I paid this amount in cash, I would have availed this credit and I would have paid this much amount lesser in cash. So if my outward liability in cash is more than the RCM amount to be deposited, the government has suffered nowhere in terms of cash amount being received by them.
Yes, yes.
So these are two scenarios which we are also considering, and you can also take it as a legitimate argument in your
Yes.
submission.
Because when I started arguing with them, they said this will be a sunk cost. You cannot claim the credit, but I have my section says no, client need not pay. The client should not pay double time tax. So at least if you take that logic, he has to get either that as a refund, the forward charge as a refund, or this RCM as a refund.
Yes, sir.
So,
Sir,
thank you.
Arpit sir.
So, first of all, I would like to salute you for your patience, sir. You have a lot of patience. I recall my days now when I attended for the GST course. So there I had this type of classes and all. Now for the workshop also you made like that, sir. Thank you very much.
Thank you, sir.
Sir,
Thank
Amrut
you.
sir and Arpit sir.
Yes, sir.
In my view, getting clarified one question totally is better than discussing more than one question. So in continuation of Amrut sir's question, I am continuing the same discussion. Amrut sir, when you have said the royalty has been paid under forward charge, have you collected from the customer?
Yeah, sir. We have collected from the customer, sir. It is
When you have
LNT.
collected, when you have collected from the customer and remitted to the government, you cannot make an unjust enrichment out of that 5%. Now, because if you collect it and you have to refund it to the customer. One question.
Yeah,
No,
sir.
sir.
We will refund it, sir. Once
No,
we
sir.
get the refund,
What Amrit is saying, that had I paid RCM in cash,
That
I would have supposedly take an example that my RCM liability is 100 rupees and my outward liability is 150 rupees. So without claiming the credit of RCM, I have deposited 150 rupees in cash.
Sir, here the Amrit sir, questions are two questions. One is they have remitted it in the forward charge. If they have remitted under the forward charge, they might have been billed to the customer under forward charge and collected and paid. One question is over. Second question is they have not remitted under RCM. They want to remit it now and take the input tax credit. For that, revenue neutralizing factor is there, though there is no impact on the revenue subject to there are proportionate for rule 42-43 is applied. Then that problem will come because you are supposed to reverse the tax credit. Because of rule 42 and 43, you will not be eligible for total credit. Revenue loss is there. That is the reason. To that extent, you have to pay back to the government with the interest. But here the question is, it has been collected from the customer and remitted to the department. Right, sir? Amrut sir, am I correct?
yeah, you are absolutely right.
What I am trying to say is we can understand with an example.
Sir.
Supposedly your forward charge liability is 150 rupees
Sir.
and your reverse charge is 100 rupees.
Sir.
Ideally, what you would have done is 100 rupees paid in RCM and claimed as credit and 50 rupees paid balance in cash for outward liability. So thereby your cash component would have had cash liability would have had two components, 100 for RCM in cash and 50 for outward liability. But now since you have not paid the RCM, but you have paid the entire 150 rupees in cash. So somewhere down the line, you have equally compensated for the government without claiming ITC. You still have deposited the entire 150 rupees in the cash ledger of the government. So you can plead revenue neutrality in such cases. But only provided that your liability in cash should be more than the liability for RCM.
Even this forward charges, sir, we paid in cash only, no?
Yes. Your liability, your discharge method while filing 3B should be in cash, not through ITC available in your credit ledger.
Thank you very much, sir. Thank you very much.
Thank you, sir. Good, sir.
Before I put in my words, any other person attendee is having any question, please proceed. No one. So अर्पित मैं ये लिबर्टी लेता हूँ, मैं भी कुछ पूछ लूँ.
Yes sir, sure sir.
एक तो ये है कि विथिन 6 months पेमेंट नहीं दिए तो आईटीसी रिवर्स कर लेना.
हाँ जी.
ये तो नॉर्मल बिजनेस में साल भर तक पेंडिंग रहता है. अब जैसा ऑडिटर का ही है, 2 साल फीस नहीं आती है, तो ये ड्रेकोनियन टाइप का ला है एक. तो दूसरा, अगर कुछ गलती से मिस आउट हो गया है तो रिवर्स करना, तो कैसा होना उसका?
तो देखिए, पहले अगर हम 180 डेज में रिवर्सल की अगर बात करते हैं, तो 180 डेज में रिवर्सल जो हमने शुरुआत में बात करी थी कि गवर्नमेंट माइट अटैच सम कंडीशंस फॉर द पर्पस ऑफ क्लेम ऑफ आईटीसी, एंड दिस इज वन ऑफ सच कंडीशंस. If you have not paid to the supplier, then you would be liable to reverse the ITC, and whenever you pay it, you would be able to reclaim it. ठीक है, तो ये कंडीशन हो सकती है वहां पे, कोई गवर्नमेंट के पास पावर है कि कोई भी कंडीशन अटैच कर दे, बट एट द सेम टाइम अगर मैं एज फ्रॉम द पॉइंट ऑफ व्यू ऑफ द डिसिप्लिन देखूं, तो आप देखिए गवर्नमेंट क्या कर रही है यहाँ पे कि अगर मेरे सप्लायर ने, मान लीजिए मेरे को 10 रुपए का टैक्स दिया, तो मेरे सप्लायर ने वो 10 रुपए गवर्नमेंट में जमा करा दिए। अब मैंने वो 10 रुपए सप्लायर को नहीं दिए, तो मैं वो आईटीसी नहीं ले पा रहा हूं, और जो मेरी आउटवर्ड लायबिलिटी मान लीजिए 15 रुपए की, वो 15 के 15 रुपए मेरे को गवर्नमेंट में कैश में जमा करानी पड़ रही है। तो हमको ऑन द फेस ऑफ इट तो ये लगता है कि ये एक प्रोविजन है विच इज बेनिफिटिंग द सप्लायर, पर इसका एक्चुअल बेनिफिशियरी जो है दैट इज गवर्नमेंट हु आर हैविंग अ अनजस्ट एनरिचमेंट बाय वे ऑफ प्रोविजन, बिकॉज at one point they are collecting tax from the supplier, but at the other point they are denying ITC to the recipient merely because he has not paid the amount to the supplier. So they are somewhere in the line coming in the free trade or practice between the supplier and the recipient. And when we see the reverse case, जहां पे supplier ने tax नहीं जमा कराया तो वो recipient को ITC deny कर देते हैं, तो वहां पे वो बोलते हैं कि नहीं नहीं ये तो आपके बीच का मैटर है, यू हैव टू सी दैट इफ द सप्लायर हैज नॉट डिपॉजिटेड टैक्स सिंस इट इज अ पार्ट ऑफ सेलिंग प्राइस, यू वुड नॉट बी अलाउड द क्रेडिट ऑफ द सेम। तो सेम एनालॉजी यहाँ पे क्यों नहीं लगती कि इफ द सप्लायर हैज डिपॉजिटेड टैक्स बट रिसिपिएंट हैज नॉट पेड इट विद इन 180 days, he should not be devoid of the credit claim. So on the face of it, हमको there is a justification attached to giving to the credit, but when we go to the deep, then it is an unjust enrichment on the part of the government, wherein it should be suitably challenged before the court.
That is what, because in tax audit under Income Tax Act, otherwise while determining the correct liabilities for proper reporting, you have to check each and every transaction. प्रॉब्लम हो रहा है एक तो, दूसरा मेरा क्या है, as you told that ITC can be denied if supplier has not remitted. When purchases are accepted, how they are denying, how it is proper to deny input tax credit? They should also not accept purchases.
Yes, so that point that I am a genuine purchaser is before many high courts in GST regime as well, and has been challenged recently. You also would have come across a judgment of Calcutta High Court wherein notices has been issued for 16(2)(c), wherein right has been denied to the genuine purchaser. So all things you have said that it in case of genuine purchases the ITC should not be denied, I fully agree to it. And most likely what has happened in VAT regime in Rajasthan High Court, wherein they have read down the VAT law provision which denies the ITC to genuine purchaser. Similar fate I see in GST regime as well, wherein the provision of 16(2)(c) would be read down with a ways for the genuine purchasers.
Still two more questions from my side. Suppose under this monthly payment scheme, new scheme, if input tax credit is more than output, what is the payment? Where is the question of paying anything on monthly basis?
Yes, in that case you should go for the self-assessment method rather than the fixed sum method.
So it is fluctuating month-wise. Sometimes in each 1 month it will be like that. 1 month some payment is required in 1 month. Similarly, situation may reverse back. So a कौन track रखेगा ये scheme? Actually, it is a confusing scheme in my view.
No, it is definitely a confusing scheme, and what the situation you are saying that one month there is a payment and 1 month there is a self-assessment liability. The circular says that a person can opt for self-assessment in 1 month and can opt for can opt for fixed sum in 1 month and can opt for self-assessment in 2nd month. Now, if the circular is saying so, I find it hard enough to say that how the interest liability would be calculated at the time of filing of GST or 3B, wherein I have opted for fixed sum method for April and I opted for self-assessment method for May month. So what I would be opting for self-assessment method in April. I would be opting for cash payment in May, and then I would be filing my return and saying that since tax was paid by the due date, therefore no interest liability should be there. So it is again a confusing scheme and very rightly said. But in my opinion, most of the cases the assessee would be going for a self-assessment method for both of the 2 months.
And last one question, Haldia sir. You have told that under the, as per this new scheme, estimated 35% can be paid. A challan will be self-generated. How far it is logical? Because this whatever 35% is calculated based on previous quarter. So I want to know how far it is logical.
The government is giving you option wherein they are securing their money, just like the deemed presumption scheme in income tax. So government is giving an option which is not binding upon the assessee, and in cases where there is a huge cash payment to be paid, just like say in the case of chartered accountants, wherein there is much less credit available and tax has to be paid in cash only. So in those cases, 35% option can be taken, but again, it would be only for some of the people who would be opting for 35%, and rest of the people might be going into the self-assessment method, because as the data suggests, for the payment of taxes in GST regime, 93% of the tax is being collected by people having turnover more than 100 crore rupees. The cash component is only 6 to 7% for people having a turnover of less than 100 crore rupees. So, and also going by the figures which are there in the public domain, when such a small amount is being deposited in cash, so why a quarterly and monthly payment scheme person would be opting for 35% option is one thing to be seen. And somewhere down the line, government has brought this scheme just to ensure advance collection of tax rather than keeping it pending for 3 months at the time of filing of 3B.
It is not relating to topic per se. एक सिंपल एक चीज पूछना चाहता हूँ. How far you concur with me? When government introduced GST, their words were good and simple tax. With so many frequent changes, circular, whether it is same thing?
Neither of somewhere down the line, the good and simple tax has lost its relevance in GST. That is the only thing which I can say.
It is anything else but not simple. To me, it appears.
It is not simple, and somewhere down the line, I think that there are too many issues concerned attached to it. One is the provisions relating to input tax credit, and second is the provisions relating to filing of return. And as we can see that they have brought in quarterly and monthly payment schemes, but there are so much options, there are so much complications. Now, take an example that they have said that if you want to opt out of quarterly and monthly payment scheme for the next quarter, you have to file the option between 1st of May and 31st of July. What if my returns are being filed after a delay of 6 months? That means I cannot opt for the entire period for the delay which has occurred for the quarterly and monthly payment scheme if I am filing on a monthly basis. And I cannot also opt out of the scheme unless until I have filed the returns for the previous period. So again, they have brought in quarterly and monthly payment scheme. What ideally would have been there, every person having a turnover less than 5 crore in the previous year should have been gone for quarterly and monthly payment. Secondly, GSTR1 should have been an online real-time basis statement wherein people are allowed to upload invoices on a daily basis, and whatever invoices which have been uploaded up to a cutoff date is to be seen by the recipient without any concept of a return. It should have been an online real-time statement wherein the recipient supplier is uploading on a regular basis. Somewhere down the line, on the basis of which ANX1 and ANX2 were being brought in the new return scheme. So if these two options would have been there and abolish the fixed payment method, just bring in the self-assessment method and keep it simple, this would have been the ideal quarterly and monthly payment scheme. But what we have seen is a fractured mandate wherein it seems the administrators are securing their interest first and then looking after the interest of the smaller dealers.
Thank you very much. It was a very really exhaustive presentation you have given. As my predecessor, President Amrit Kota told, it was like a workshop we have attended without any CPE credit. So very exhaustive. I don't know how much of energy you have exhausted in this exhaustive presentation, but full handshake from all of us. And for any other questions, etc., I hand over to Ritesh. Please.
Thank you, sir. Thank you.
Thank you,
Arpit sir.
Arpit, for such a exhaustive.
Ritesh sir, 1 minute. I want to express my view. Sorry for
Yes.
extending the period. Arpit sir, I had many questions on section 16 with notices, almost 4 or 5 notices on my table to reply. Almost I got all the reply for all the notices from this session. Thanks for help.
Thank you, sir. Thank you very much, sir.
Right, Arpit, thank you very much. We enjoyed
you,
the
Arpit
session today.
Ritesh, continue with any questions in the chat
Yes, sir.
box.
Yes, sir. I don't see any questions in the chat box, sir.
I have one question, Ritesh, if you permit.
Yeah, please continue. Yes, please.
पूछ भाया, क्वेश्चन पूछ.
हेलो.
बेगा भी टाइम होगी, 6 बज गई, 6:30.
हेलो.
क्वेश्चन पूछिएगा.
Sir, while filing GST at 3B. Hello.
Yes, sir.
Sir, while filing GST at 3B, what system generated RCM is coming there in the tax payable, but the payment is not going to in the account of RCM.
Liability is coming for RCM, but
yes, liability is coming, but the payment in the bank is not credited to account to RCM, only going to IGST.
Sir, I am not able to get your question. What is happening?
Sir, when the
I understand that pre-filled amount is there in the GST.
Pre-filled amount is there. Liability is also coming there, but while going to bank, while e-payment, the amount is not credited to RCM.
The amount is not going to the cash ledger.
Cash ledger.
Okay. So there is a pre-filled liability wherein you are trying to make the payment, but the amount is not going to the cash ledger and amount is not being debited.
Debited, yes, sir. Whether we have to prepare DSR 303?
No, sir. Before filing DRC 03, what you can do is you can raise a grievance on the portal regarding the same. And once you raise the portal and whatever reply, in all probability, you would not be getting a reply, sufficient reply. But you have to have a documentation for that. And once you have the documentation, then go ahead and file through DRC 03.
Okay. Okay.
So with this, I think we come to the end of the detailed presentation. Arpitji, it was a very exhaustive and elaborate presentation. And we, on behalf of Telangana and Andhra Pradesh Taxpayer Association, wholeheartedly thank you for enriching us on the subject. And with this, we come to the vote of thanks, and I request our GC member, Mr. Madhusudan Bhuja, to propose a vote of thanks. Over to Bhuja. Kindly unmute yourself, sir. Yes.
Mr. Bhuja, please unmute yourself and go ahead.
Audible now?
Yes, sir. Yes.
Yeah. Go ahead.
Thanks for our president and other GC members and my colleagues in the profession. And we should all wholeheartedly thank CA Dr. Arpit Haldia for the elaborative and informative. Really, we should thank you very much, sir. I think majority of the doubts have been clarified. Normally, at the end of the seminar, there are so many questions. Now it is not possible. You are not given a chance because it's almost more than 3 hours. Very informative, sir. And let us hope we'll once again you have to give one more seminar on the different topic, especially GST matters. I request the president to we should take the advantage of from the speaker and on behalf of the all the tax practitioners, auditors, and everything from Hyderabad, Telangana. Thank you very much, sir. Thank you very much.
Thank you, sir.
Over to Ritesh.
Thank you so much. So with this, we come to the end of the session, and it's already 6:20. So this is the Arpitji, we have taken a very detailed thing. Thank you so much, sir.
On 23rd, we have a meeting.
No, sir. It's almost 6:20, but we didn't feel the time. We didn't feel the pain or yawning or anything. We enjoyed the session marvelously. Thank you very much.
Thank you, sir. Thank you very much, sir.